Welcome back to Markets Today. We are 30 minutes from the cash equities open. European futures pointing lower by 0.3%.
Here are your top stories. Asian equities retreat for the fourth day on more concerns over the Chinese economy. Strong US retail sales add doubt that the Fed's inflation fight is finished. UK inflation falls, but by less than expected, adding to the case for another rate rise from the Bank of England. Plus, the world's largest owner of stocks rebounds thanks to investments in big tech. We will break down the numbers from Norway's $1.4 trillion sovereign wealth fund. Tom, what do you see on the futures?
Well, again, China is part of the mix. The inflation data out of the UK, the MLive team pointing out that this really is going to add to the case for the hawks, at least, on the MPC to go higher from the Bank of England. But it's the sogginess that you're seeing coming through these equity markets. Futures pointing lower. Yesterday, of course, was a very rough session for European stocks. You had one sector that remained in the green yesterday, retail. The losses yesterday led by the banking sector, led by basic resources and utilities. So DAX futures point about 0.3%. Here in the UK, after a very difficult and challenging session yesterday for stocks, the FTSE 100 pointing to further losses of 0.3%. And over in France, the CAC 40 currently down by 0.4%. Just briefly reflecting on the session in the US where retail sales came in positive. And that good news was bad news in terms of how people were thinking about the Federal Reserve, how high they are going to have to go. The S&P, by the way, breaking back through its 50-day moving average for the first time since March.
OK, so that expectation for European stocks may be something to do with yesterday's moves over on Wall Street, as is maybe then, Mark, the Asia session to do with Wall Street yesterday. But we need to talk about what's going on in China and how the weak data that we report almost daily coming out of China, or the weak news flow, how that is and isn't impacting stocks in China on a relative basis. I know this is of interest.
Yeah, absolutely. What's really interesting is Chinese assets are outperforming over the last month across the board. Bonds, it makes sense. We had a rate cut and China's confronting deflation rather than inflation elsewhere. So China bonds outperforming is one thing. Yuan is a haven against a stronger dollar because it's managed against the dollar. So yes, it's weakening a little bit against the dollar, but the yuan, Chinese yuan, has been one of the strongest currencies in the world over the last month. What's most interesting is even Chinese equities are outperforming. And that's really bizarre. I cannot remember the last day where this show is not focused on the horrendous China news coming through, both from the data side and the problems in the property sector, now the problems in the wealth management sector, disappointing policy. It is literally day after day after day after bad news. But the fact is, this blue line is HS Tech. This purple line is NASDAQ. You can see HS Tech still up for the past month. There's a 1 month rolling window, still up 2.3% over the past month, whereas NASDAQ is down more than 5%. The CSI 300 for the last month is only just minus 0.7% for the last month, despite all the negative news, even though the S&P 500 is actually down 3% over the same period. So Chinese equities are extremely resilient. Why is that? Well, I was asked by Valerie Teitel this morning on our chart side, if you're pessimistic China, what's the trade? Well, you should have sold at some point in the last few years or few months. Everyone who wants to sell in the China story has sold by now. There's just not much more money to come out. Now, that doesn't mean it can rally, but it's very hard for Chinese assets to fall from here. And I think that's one dynamic. The less trite answer is if you're still pessimistic on China from here and very bearish and think that the real understanding of the problems are not priced, you probably want to be playing this through the second derivatives. Some of those EM countries which have high trade links to China, which are priced a little bit more optimistically still. But Chinese assets are already pricing a broken economy.
OK, that's the China story and the perhaps surprising outperformance then relative to other markets more recently. Let's get back to the UK macro picture then, Mark. And the UK's annual inflation rate fell last month, but by less than expected, adding to the case perhaps for the Bank of England to raise interest rates once again, at least in September. What does it mean for further down the line? Let's talk to Bloomberg's Lizzie Burden, our UK correspondent, who joins us with details. Lizzie, good morning. So traders holding bets steady this morning after that UK CPI print. CPI dropping, but it did come in a little more than expected. But that's because, of course, yesterday at the hot wage data, we saw higher expectations of rate rises. So they've already kind of done that move this week. What do you make of the data?
Indeed, traders seeing a peak rate of about 6% for the UK. And our economists at Bloomberg Economics reckon that would trigger a recession. You've actually had some analysts at TD Securities and Saxo Bank off the back of yesterday's jobs data seeing a half-point hike in September. But, of course, we still have more jobs and inflation data before the BOE's next meeting. If you break down this latest batch of numbers, headline CPI, as you say, hasn't fallen as much as economists were expecting. Why? Well, the main driver upwards was transport costs, but the main drivers downwards were food and energy costs. So if you strip them out. Core inflation has held steady even though it's expected to fall, and services inflation has actually risen to 7.4%, so it's the highest since March 1992. If you break down why, ING says that that's because of a rise in rents and airfares, so they're not too concerned, but nonetheless overall for the Bank of England it is a bit concerning because of, as you say, you mentioned wage growth. The concern is domestically generated inflation. That's what those jobs numbers pointed to, and hence why you've seen the pound rising slightly on these numbers. But as you say, bets for peak rates staying the same.
OK, UK correspondent Lizzie Burden with a breakdown there of the CPI print coming through for the UK. Thank you. We'll stay on this story and bring in Parisha Saiba now, rate strategist at BNP Paribas. Parisha, good morning. Thanks for joining us in the studio. Why are markets wrong to be betting on a peak rate of 6% from the BOE?
Well, we don't think that they're wrong. Yes.
You've revised up your forecast then?
We have not. So we're only looking for one more Bank of England rate hike, but we do see increased risks that the terminal rate may be slightly higher, especially given the latest data that we've had. I think the biggest surprise was the data that we had yesterday on the labour market. As Lizzie mentioned earlier, there's some airfares tick up, which can be a bit volatile on the inflation data. And there was still some improvement on the food prices as well, which is, of course, a key component that filters through to consumers' inflation expectations. But I think on the whole, yes, the Bank of England will need to do more. The markets were right to reprice expectations, but we don't necessarily think that that will be delivered. Certainly not necessarily up to the 6% level the market's pricing.
So are you sceptical that we could see something like a 50 basis point hike in September? Does the data look as if it justifies that? We spoke to Saxo Bank just yesterday on the programme, and as Lizzie was saying, they are now suggesting we could see a 50 basis point move again in September, but other voices saying no, that the Labour story is actually moderating and there's no need for that kind of move.
Yes, I think a 50 basis point is still a little premature. Remember that we already saw the Bank of England deliver 25 basis points at their last meeting, stepping down from that 50 basis points before. So I do think that hurdle to go at 50 basis points again is a little high. We have seen some moderation in inflation. We have seen some moderate improvement, some glimmers of hope, should we say, in some labour market aspects. But clearly the Bank of England still need to do more. I think, though, it's still hard for the pound to really respond to this better data and higher terminal rates, though. Yes, we've seen a little bit of a push up in the pound in response to the data, but ultimately either the UK will have an inflation problem and further hikes are needed, but ultimately we could see a sharper downturn on the back of it, or the Bank of England failed to deliver on the market's expectations, and that repricing could also weigh on the pound.
Mark.
Parisha, good morning. I love it. You're talking my language in the pound, so I won't be difficult and ask you another one there. I want to actually swivel to your highest conviction that this is still an environment for carry. Now, this year has been like a great year for carry generally, but obviously this month has been very tough. And I know one of your top picks is short Euro Brazil, which, you know, fundamentally I really kind of have a lot of sympathy for, but it's had a really tough week. Are you concerned at all by the price action, or do you think this is just a great chance to get back in? And what's your kind of time span for this trade, or targets for this trade?
Sure. So I think certainly this week there has been another battering to the analysing, and also our risk premium indicator is back in positive territory, or something that we would suggest means it's now attractive to actually be adding FX risk here. So while the news flow has been a little poorer and it is something for us to watch, I think unless we were to get a real US slowdown and a US recession coming onto the cards, we do think that the carry trades can continue to perform. You mentioned Euro Brazil as one of our favourite trades, and we did, and we do like that, and we do think that can continue to perform over the coming months, up until that point where we do get that real slowdown in the economic data coming out of the US.
OK, so that pairing around Euro Brazil potentially further upside in the coming months in terms of the carry trade. You have to think, of course, about the US dollar in light of all of this. One take from the data, the retails data yesterday out of the US is that the soft landing theme has just become more pronounced. The other side of that is that the Fed is going to have to go higher and is going to have to hold for longer. How are you thinking about further potential upside for the US dollar, or was it most of that priced in now to the greenback?
So we do think that the dollar will be able to weaken structurally. Certainly, if we look at global investors and how they're positioned, they've become overweight the US dollar over the years where we've had negative interest rates and QE. And given that we're now in a more normalized world for policy rates, there are alternative assets for these investors to buy.
So what's your favourite cross to play that dollar weakness?
So we do like fading the dollar against NOK at the moment. That's a tactical view of ours, but we do think that there are supportive upside fundamentals for the NOK itself, but also that dollar weaker view that we have, especially in this environment where risk premium is suggesting it's attractive to be adding risk. And given that positioning has lightened up, we think at least tactically it makes sense to be adding risk here, and that's why we like the dollar NOK short.
Parisha, how are you factoring in the risk of a resurgence in inflation? We've talked about the sort of competing stories that are being discussed around inflation. Central banks still trying to talk tough, but at the same time, we've seen these disinflationary forces actually in markets in recent months, bringing inflation down, certainly in some developed markets, over in the US notably. Are you thinking about the risks that inflation reaccelerates from here?
I think we always have to consider that risk. Certainly markets have been surprised in that direction for much of the past year. And so we definitely need to consider that. And I think when we look at the rates markets, there is an increasing premium being priced in at the back end. We're seeing inflation break-evens widen out to respond to this idea that maybe a softer landing will see inflation tick up again. But for us, we do think that the data in the US will eventually decelerate. We're seeing some increasing signs of that in the US, including on the services inflation side. We are seeing the labour market beginning to cool as well. And so all in all, we do think the data will prevent the Fed from needing to deliver further tightening this year.
Parisha, thank you very much. Thanks for joining us. Parisha Sainbi, rates strategist at BNP Paribas, with a view on gilts and the Fed and beyond. Now, coming up on the programme, your stocks to watch in focus, including Carlsberg, which just announced a 1 billion Danish kroner buyback. We got that in the last 48 hours or so from the business. We spoke to the CEO earlier, gave us more insights on the Russia business, which were fascinating. We'll get the latest on that stock shortly. This is Bloomberg. Welcome back to Markets Today. 15 minutes until the start of cash equity trading for this Wednesday morning. And the futures picture points lower, reflecting the US session of yesterday, really. Let's look at some of the top red stories on the Bloomberg terminal then this morning. European natural gas futures spiked yesterday for the second time in less than a week. That's as tensions run high over the possibility of strikes in Australia that could severely tighten the global market for liquefied natural gas. Discussions between union officials and one of the two companies operating the affected facilities yielded no firm outcome to the labour dispute. The philanthropic organisation that controls most of the $25 billion in assets in George Soros' family office is set to end most of its operations in the European Union. As part of a retrenchment under new leadership, the Open Society Foundation told Bloomberg it's introducing a new operating model. The changes also come as the foundation cuts headcount by some 40%. Vietnamese EV maker VinFast soared in its first day of trading in New York after going public in a SPAC deal. Shares gained 255%, giving VinFast a bigger market cap than GM, Ford or BMW. However, just 1.3 million shares are available for trading, with most locked up by the company's founder and his family. BlackRock is among companies bracing for tighter oversight in the United States following a congressional inquiry into investments in Chinese companies deemed to be national security threats. The Biden administration signed an executive order last week limiting U.S. investments in China in key technology industries. Vanguard, Fidelity and DWS also manage funds with investments in China, some of which are the type that Congress is investigating.
OK, let's check in on what you need to know then heading into the open. Sam Umstead joins us from our Markets Today blog. And Sam, we're still going through and weighing up the implications of this retail data and some earnings coming through from some of the big retailers in the US. How do we think about that leading into the session?
I think so. Retail sales data from the US yesterday, very resilient. That is, we've seen that kind of broadly everywhere. Consumers have remained very resilient. Some of that is inflation pushing through into food prices. So the figures maybe are being influenced a little bit by that. Today, we've got Target coming up. We had Home Depot yesterday. DIY spending actually appears to have held up pretty well. But Target makes an enormous amount of its money from this area of electronic goods, so TVs, fridges, white goods. That's an area where we have seen a bit of a squeeze, where people are holding back on those purchases. So it'll be interesting to see how Target want to reset expectations today.
Mark?
Sam, for most of the last weeks, or in fact most of the last couple of years, it's been the property sector we've been super worried about in China. And now, finally, it's spread to maybe an even more worrying problem, the wealth management sector. What's your latest take on that?
Well, Mark, my latest take on it, I always go to Sophia Horteri-Costa on the Markets Today blog for anything China. And she was telling me this morning, and I think this sounds right, as you've kind of said many times, Mark, the news out of China is really negative. The sentiment there is really poor. This story adds to that. But she was saying to me that some of this appears to be, linked to the property sector and the weakness there as well, and spreading even further into the economy. But at the moment, Chinese assets still not seeing that big reaction that I think everybody was expecting to see, given how bad the sentiment is.
And Sam, let's get your thoughts on another market that is influenced by things that happen far and wide and has far-reaching implications when it moves, and that is the LNG market.
Yeah.
And what we're seeing reflected in European gas prices, those prices jumping once again, all to do with Australian labour market.
Yeah, it is. And actually, again, this is one of those incremental stories in the inflation picture that not gets lost, but it has been kind of forgotten about a little bit because energy prices have come down so much over the past year. We saw that in the UK inflation data today. This is another worrying sign because this is a strike action in Australia, probably will reach a conclusion at some point, but how much damage gets done to the LNG price in the meantime, we shall have to see.
Sam, thanks very much. Sam Umstead from our Markets Today blog. You can find that blog by going to the Bloomberg UK website, and you can click through to the blog from there, or you can type TLIV GO on the Bloomberg terminal. Now let's get your stocks to watch. Joe Easton from our equities team joins us. And Joe, I know that you were watching as those Carlsberg, the early release of those Carlsberg numbers hit the Bloomberg terminal yesterday. So you wonder if some of that's already in the price. But we've got some really interesting lines this morning on Russia from the business. What stood out to you?
Absolutely, Anna. So we did get a chunk of this earnings report yesterday, as you say, with some of that guidance coming during the market hours from Carlsberg. They raised their guidance once again, continuing an impressive run of them pushing up their earnings outlook. And that one did please investors, with the stock rising about 2% yesterday, as we can see from the screen. But this morning, they've also given us some fresh lines in terms of a new share buyback. That's worth around 1 billion Danish kroner, which translates to around 150 million US dollars, and their 1H earnings are actually slightly better than expected as well. If we see from a year-to-date chart, I've brought it up against the big rival Heineken, we can see that Heineken sank following their recent guidance when they said that consumers were cutting back on beer due to the higher prices. We don't seem to be seeing that from Carlsberg today or yesterday in that report, and that seems to be a relief which should potentially help the stock again today, Anna.
And Joe, you're also looking at BME, which is a London-listed retail business.
That's right, Tom. So B&M, ticker BME, they could potentially be bidding for some of the collapsed Wilko stores, which is the UK discounter that's gone into administration. Now, this stock has risen 2% yesterday, about 5% over the past couple of days in terms of BME stock. Poundland is another potential bidder for this, so it's the two companies potentially battling it out, and it could give them around 300 Wilko stores that will be vacant. Analysts at Shore Capital saying that they should really be bidding for the ones that aren't based on the high street, that are outside of the main shopping streets, given they haven't seen the same decline in footfall since the pandemic. As we can see from the screen, a lot of positivity on B&M shares. So FTSE 100 member with around 11 buy analysts and only 2 sells, expected to be a bit more resilient during the recession given the discount offering. So that's one to watch today, Tom.
Joe, good morning. We had another couple of UK earnings, Aviva and Admiral. What were the stories there?
So it's a bit of a picture on those two, Mark, bit of a mixed one. In terms of Aviva, they had surprise weakness in their insurance. This is the largest life insurance provider in the UK, and they're actually missing one of their key lines, which is the combined ratio, a key profit number for insurers. However, their asset management division holding up well. We saw Legal & General yesterday reporting a slump in assets, and it doesn't look as bad over at Aviva. That looks pretty positive. Meanwhile, Admiral, now this is much more in the personal lines, so car insurance, home insurance, that kind of thing. They're managing to push up their prices and are not seeing a decline in demand for their insurance products, which does look to be positive. We can see I've brought those two stocks up here, Aviva and Admiral. Aviva has underperformed, but that's mostly due to the outflows in their asset management arm, and that looks positive today. Not as bad, as I say, as what we saw from Legal & General yesterday.
Joe, thanks very much. Our equities reporter Joe Easton with some of the stocks that could be on the move, and we'll certainly get Joe back. We'll return to those themes. We'll check in on those as the markets open in around 8 minutes' time. So, Mark, just minutes then until the start of the European equity trading session, and it does look as if we are playing yesterday's story a little bit here in Europe. European futures are weaker. The retail sales story knocked confidence in risk assets stateside yesterday. I wonder what you expect from the session ahead, given, actually, we haven't mentioned, we've got important data coming out from the US and minutes, of course. US futures are fairly flat.
Yeah, we've got some big data, and you said the Fed minutes, so there'll be big factors later on. But I do think it's really interesting, especially given we had that hot CPI print, and that's been the kind of story, is that yields are softer today. US yields have come down a lot, and there's quite a turnaround in the late US session, and that also means the dollar is slightly softer today. I do not want to dramatize this, but the theme of August has been risk aversion amid the fact that we've had a relentlessly climbing dollar and higher yields and a very negative China story. The negative China story remains, but it looks like we're at least getting a pause in the dollar strength and higher yield story.
I'm glad you mentioned fixed income over in the US. So the 10-year, 417, and a story coming through from Steve Major, of course, of HSBC, saying that now is a good entry point, Mark, for the 10-year. The yield on the 10-year US Treasury is at the top end of its range.
Look, Stephen Major is the most articulate Treasuries bull on the street, but he will always be a Treasuries bull. And so what he'll do is give you the most compelling argument for Treasuries, but he almost always thinks it's a good entry point. He has a very good framework. I value his work an awful lot, but I can't say it's a surprise he thinks it's a good entry point for Treasuries.
OK, pushing back on that call there from Stephen Major of HSBC. Mark, of course, thank you for walking through some of the key market themes for us this hour. You'll be back, of course, tomorrow with the analysis as we look at European futures pointing lower by 0.3%. US futures are flat after the S&P crossed through its 50-day moving average for the first time since March. The Open is next. Stay with us. This is Bloomberg.
A few minutes to go until the start of cash equities trading. Welcome back to Markets Today. I'm Anna Edwards in London with Tom McKenzie.
And here are your top stories. Asian equities retreat for a fourth day on more concerns over China's economy. Strong US retail sales, meanwhile, adding doubt that the Fed's inflation fight is indeed finished. UK inflation falls, but by less than expected, as the cost of travel and holidays climb. Traders hold BOE bets steady. Plus, the world's largest owner of stocks rebounds thanks to investments in big tech. We will break down the numbers from Norway's $1.4 trillion sovereign wealth fund. So, Anna, we're back in UK territory with the inflation print coming through slightly stronger than expected, and China negative again in terms of the news flow.
Yeah, absolutely. As Mark was telling us at the end of the last hour, the China theme, the negativity around China is still with us very much in markets. And that was certainly something that's been weighing on the Asia session. We've got MSCI Asia Pacific down by more than 1% as we head into the European session. Is that really just yesterday's story, though, reflecting Wall Street and the sell-off we saw in risk assets, in stocks, as a result of that retail sales picture? Forward-looking, US futures look entirely flat, actually. So you can see S&P futures are flat this morning. The pound is at 127.27, up 0.2%. It goes higher once again in a sort of knee-jerk response to that slightly higher than anticipated CPI print. It has stepped down a lot from last month, but still a little higher than expected. And Tom, I also mentioned natural gas prices, because once again we're being sort of whipsawed by that story. This has a lot to do with the Australian labour market, of course, and whether we'll see resolution to disputes there. A very globalised picture for gas markets right now. Tom, what do you see on futures?
Yeah, and a reminder that energy complex could provide something of a pushback to the disinflationary theme that we've seen coming through. The FTSE 100 futures pointing lower by 0.2% after the selling of yesterday. DAX futures lower by 33 points, and over in France, losses of 0.3% flagged by these futures, Anna.
OK, so futures points lower, expecting to see a bit of weakness at the start of the European trading day. We get the FTSE 100 then down by just a fraction, as it is the first out of the gates this morning. Here's the move in the pound we're talking about, up by 0.2%. Another reminder this morning of the pressures on the Bank of England, on the thinking around how many rate hikes there'll be from here. It seems that markets have left their expectations of how many hikes we get unchanged, but that's after they stepped those expectations up yesterday on the back of the strong wages data. So we're waiting to see what happens on the gilt market story as gilts open. There you go. I just saw there's the 30-year gilt just popping into the GMM, the 2-year. We are seeing those yields rise. And what's interesting, actually, is that the yields are rising on UK gilts when they're not rising elsewhere. As Mark was pointing out at the end of the last hour, we're getting a bit of a relief from August's theme, which has been around a stronger dollar and higher yields. That relief coming in the US 2-year, you can see there, and broadly across treasuries. And that applies to the rest of the European rate space, but not to the UK, where we seem to be going in our own direction as a result of what we saw on that inflation print, Tom, earlier on today.
Yeah, Anna, selling across the main sectors so far this morning. I'll point out technology currently down as a sector 0.5%, even if yields start to moderate somewhat across the US Treasury curve. Basic resources now down a full 1%. Of course, you can tie that to the property sector in China and expectations that there's going to be less demand for the likes of iron ore and copper on the back of a second straight month of falling sales. And again, those concerns just percolating through the real estate market and the linkages to the broader financial system of China. Currently, that sector, basic resources, down a full 1%. Energy also taking a bit of a hit. Of course, you have seen some upside for oil over the last 30 days or so, but currently as a sector down 0.6%. Industrials also taking a bit of a hit, down 0.5%, and financial services off by 0.5%. Just one sector so far in the green, reflecting what we saw yesterday. It was retail, the only sector that remained in positive territory yesterday, and so far in the first few seconds, retail is gaining just 0.1%, Anna.
OK, so that's what we see on the sector breakdown. Let us get to what's happening on gilt markets. And actually, things taking a little while to settle down this morning in terms of the gilt market trade. Got a yield on the 2-year, 5.085. It seems those yields coming down a little bit now. Sam Unstead joins us from our Markets Today blog, and he's been poring over all of the details on that CPI print. I suppose, in a sense, there was something for everybody in CPI, wasn't there? There was the big step down at the headline level, but the number was a little bit higher than the market had expected.
Yeah, I think that refrain is almost all UK data at the moment. So there's something for everyone. There's something for the bulls. There's something for the bears. If you were going into this expecting to see inflation come down further, it didn't happen. So those actually, one thing that's interesting, I suppose, is that the wage growth yesterday seems to have taken a bit of the air out of today's print. You're just saying gilt market's not moving a huge amount. They did move quite a lot yesterday. Stocks got hit very hard. It feels like that kind of took away some of the surprise from the CPI. And of course, it was only slightly higher than expected. We had actually warned a couple of times on the blog, January, we did have a downside surprise on inflation, then 5 in a row that were hotter than expected, and that's now happened again.
That's why we need to read the blog. We do. That's why the audience needs to read the blog, because you preview some of these things and you have the finger on the pulse of how some of these things may work through the markets in terms of the macro data as well. When it comes to the, you talk about the mixed bag in the UK, it's a mixed bag in the US as well. And we know that the FOMC now on the Fed are increasingly divided. We had the minutes out later today. What is the kind of forecast? How are we expecting those divisions to kind of play out?
I think, so we talked earlier about retail sales, still very resilient. So that has to feed into the picture again. These are obviously the minutes from the last meeting. I think what we're expecting to see is a split. You know, it's certainly in terms of how long they can pause for, if they can pause at all. I think the debate is just going to continue there for quite a long time. And it's a picture you're seeing with a lot of central banks at the moment. You know, they're just waiting, because they are so data dependent, they are waiting for that data to all come in line with each other so that they can finally move in the direction of a pause.
Market's still pricing in a pause from the Fed. Jackson Hole next week.
Get
a speech, of course, from Jay Powell. We'll see if that clarifies the next steps and the next direction of travel for the Fed. Sam Unstead, thank you from our Markets Today blog, of course. You can get more from Sam and the team on the front page of the Bloomberg UK website, or by typing TLive Go on the terminal. Let's get to some of the individual stocks and equities on the move then with Joe Easton. Joe, you flagged the number for us leading in to the session. Carlsberg was part of the mix there. What else is jumping out to you?
So Carlsberg, first of all, coming down around 2%, pretty much giving up all of that gain that we saw yesterday. Quite interesting, given the guidance was upgraded during yesterday's session. We've got a share buyback today that we didn't know about. I'll have to read into some analyst reports there and see what the reaction is to that. Meanwhile, the UK insurers, they looked pretty mixed. Aviva seeing some outflows over at its asset management business, but not as bad as what we saw from Legal & General. So that one up around 1%. Admiral, meanwhile, outperforming, given they are managing to push up some of their pricing on their home insurance and also motor insurance as well. So that seems to be positive. Ticking even further higher on the screen there, now up around 3%. Now, Demont, this is one of the biggest makers of hearing aids in the world, around a $10 billion company over in Copenhagen. They're upgrading their guidance this morning, and that's pushing a bunch of stocks higher in that sector, including GN Store Nord, their big peer there. So that one doing pretty well over in Copenhagen. And we're going to flip over and have a look at these UK stocks following that data that Sam Unstead was discussing. Now, most of those actually coming down into the red. So Lloyds down 0.3%, the most exposed UK lender, of course, with yields coming slightly higher, as Anna was mentioning a moment ago. And we're just seeing land securities as well. Real estate really exposed to the higher interest rates, of course. That one down around the same amount. Now, Persimmon, the big home builder stock, this one obviously very dependent on mortgage rates as well. But there is an analyst report saying that this company may actually drop out of the FTSE 100. That's according to analysts over at Numis, who say that their decline could see them drop out of the main UK index. Next, pretty much unchanged. All of those stocks gained yesterday in terms of UK retail following Marks & Spencer's surprise guidance upgrade. So some of the positivity now priced in there, and that stock pretty much unchanged, down around 0.1%. Then we're going to flip over and look at my favourite screen, the ratings changes. So we have 3 downgrades at the top. Segro, they are cut at Barclays, who say that the company has highlighted customers in terms of warehouse customers. This is a real estate firm. They are slowing their decisions on renting out warehouses in the UK due to the economy declining. That one down 1%. And Antofagasta, also in London. This is a copper miner, really dependent on the copper price coming back up. And we're not seeing that at the moment. And that one gets a downgrade over at RBC. And then in terms of another downgrade, Telefónica, I can't get my that one downgraded at JP Morgan. This stock fell off a cliff a couple of weeks ago after news that O2 is potentially losing market share over in Germany, with Vodafone coming in, a new pact there. Meanwhile, Trainline, getting another one wrong. Those ones that get a new buy over at Shaw, that one is on track, according to Shaw, to beat expectations. They provided the pun, not me. Shout out to them for that one.
Joe Easton, thank you very much indeed for some of the stocks to watch, some of the movers this morning, this Wednesday morning. Let's check in on what's happening. A line crossing on the semiconductor space, the chip space coming through from Intel. We had reported on this, so they have now scrapped their deal, what was going to be a deal to take over a semiconductor maker in Israel. It's going to be a $5.4 billion acquisition. This is because Chinese regulators have not approved the deal in time for the deadline. You can have a look, of course, at the geopolitics between Washington and Beijing for maybe some of the reasons behind that. This, though, is consequential for Intel because they are in a multi-year restructuring campaign under Pat Gelsinger to try to make up for some of the losses in terms of building out some of the more sophisticated chips. They were hoping this acquisition would help them build out foundries to kind of compete, at least on some level, with the likes of TSMC. This will be a bit of a setback on that basis. But in terms of how this moves the stock when the trading starts in the US session, questionable given that the stock has kind of reworked or worked through some of this on expectations that the Chinese wouldn't approve this deal. So that's the latest on Intel giving up its deal to take over this Israeli chip maker.
Yeah, there have been doubts about whether this would go through. And sticking with China themes then, Tom, Chinese shadow bank Zhongrong is reported to have said it's untrue it's suspended making payments for all its products. The firm's liquidity challenges underscore troubles in the property sector, where new home prices in China dropped for a second month in the month of July. Let's bring in Bloomberg's China government and economy editor, Jill Deeses. Jill, this was just the latest in a number of negative stories surrounding China that we were covering at the beginning of the week. But what is the latest and what's unfolding at Zhongrong? What is it telling us? What does it signal about contagion in the Chinese economy?
Of course. Yeah, thanks, Anna. I think, first of all, I want to point out, I was reading through that Securities Daily report on Zhongrong, putting out the statement. I want to say it says they're suspending making payments for all of their products. Though, obviously, we've reported that on some of their products, they haven't been making these payments, right? So I think that still kind of underlines that there are some pretty serious concerns going on with, not just, the shadow banking company, but, some broader concerns within the sector and whether that means that there's contagion risks that are sort of spilling over from the property sector, as we've been reporting all week. The big concern here is that when you're looking at wealth management within China, like how many of these investment products are actually tied to the broader real estate sector, which, of course, as we know, has been experiencing a tremendous amount of turmoil and crisis over the last several, months, really years. And I think that continues to be a concern going forward. So ultimately, this does still spell some financial risks within China that we're keeping a very, very close eye on at this point.
And meanwhile, Jill, we're getting downgrades in terms of the growth forecasts from the likes of JP Morgan. What's interesting is not necessarily that they're downgrading, although they have downgraded from a pretty high number at the start of this year, but they are now expecting China and the growth there to come in under and below the target that the government has set itself. What is the outlook now as we weigh up the leverage in this economy and the risks around property and the financial sector?
Yes, Tom, I think that's exactly right. That concern now is shifting to this idea that China could undershoot its growth target. I mean, if you look at the JP Morgan downgrade, for example, they're looking at 4.8% growth for 2023. This is an investment bank that was saying 6.4% growth was what they were expecting out of China in 2023 just months ago. So this does, I think, have some some implications for if this recovery does not get back on track, if supportive measures don't come through that are able to address these underlying issues with demand and confidence in the economy, if some of these issues within the property sector aren't resolved, does that ultimately spell some serious trouble for the growth outlook for the Chinese economy going forward? That's, I think, you're starting to see more of that conversation bubble up now around some of these points.
OK, and the reporting from Jill Deeses and the team on the ground in Hong Kong and China is essential reading right now as we monitor this economy. Thank you, Jill, of course, for the latest on what is happening in China. Stay with us for more. We're going to get more analysis, more market analysis on this inflation data out of the UK and, of course, the next steps for the Fed ahead of those FOMC minutes. This is Bloomberg.
Right now, inflation is coming down. We've made some progress, some good progress. I feel good about that. It's still too high. The good news is the labor market has remained very strong, but it's a little bit of a double-edged sword because the question in my mind is, have we done enough to actually get inflation all the way back down to our 2% mark, or do we have to do more?
OK, that was Minneapolis Fed President Neil Kashkari speaking yesterday about the US inflation fright, indicating the battle is not over yet. And talking about a double-edged sword, let's bring in now for more takes on this Haig Barthgate, head of investments at Atomos Investments, on the macro picture, on these central banks and how to position in this environment. Haig, thanks for joining us in the studio. Let's start with that double-edged sword then. We saw the retail sales data coming out of the US. We talked about how strong that was. Does this add to the consensus view, well, somewhat the consensus view, that we're going to get a soft landing in the US, or does it sharpen the claws of the hawks and the Fed?
Yeah, well, I think the position in the US is very different to what we're seeing in the UK. You've seen a much more normal trajectory in terms of the way that the rate cycle has been working. Obviously, what the Fed are acutely aware of is they don't want wage inflation spiralling into this sort of second order effect and feeding through to consumption. But I think we're starting to see tentative signs that we are very close to terminal rates in the US, and certainly we can see again compared to the UK that the rate expectations in the yield curve are substantially below what we're seeing in the UK, for example, at the moment.
And so what are you focused on when it comes to the US story right now, Haig? Is it around the inflation fight and rates staying higher for longer? Or is it around the disinflation impulse continuing? Or is it a resurgence in inflation? Where's your focus?
Yes, I think it's all about peak rates, because ultimately that's the thing that's going to feed into the markets. Obviously, the US stock market is much longer duration, much higher tech component, and that's obviously why we've seen large cap tech performing very well, but we haven't really seen it until a few weeks ago, and obviously that's retrenched now. We haven't seen it feed through to a broader range of smaller tech. So I think that's what everybody's focused on at the moment. Do we see it pull back? What does that do to treasury yields? And how does that feed into long duration assets like tech companies?
Does that call on peak rates from the Fed then pull you into other sectors in the US? Are you attracted by some of the valuation propositions beyond tech?
Yes, I think the good thing about the US is if you're positive on the rate cycle and you think rates are going to start falling, you do have the long duration assets in the US. Coming from the UK as well, if you get it wrong and it goes the other way, it's still the reserve currency, and I don't believe that the dollar's dead. And I think if you do see some sort of pullback, and of course what we have to be careful of at the moment with rates rising, particularly in the UK at quite alarming rates, is it doesn't trigger some sort of black swan event. You know, if we do see default rates pick up, watching the financial companies' results in particular, if we do see defaults pick up, you can get unexpected things happening when we move into an environment that we haven't seen for 20 plus years.
Yes, if we see something break, where will it break is a question that we ask a lot of people and we spend a lot of time thinking about. Let me ask you about the UK, because we got the CPI print out this morning, and as we were talking with our colleague Sam earlier, there was kind of something in it for everybody, because after the big repricing we saw yesterday on the wage data, the CPI print, it did show that big drop as expected, but it was a bit hotter than expected. How are you interpreting the UK story?
Yeah, it's still of the view that some of the rate increases that we're seeing at the moment are policy errors. Rate increases have a latent impact.
So do you think the ones we've seen already are policy errors?
Yeah, I think they're errors, and obviously the market is now predicting further tightening. We see that through the yield curve. Obviously it tightens anyway. Dynamics of the UK mortgage market particularly sensitive around the 2-year mark, because we've got 2-year discounted variable rate, 2-year fixed rate mortgages are the majority of mortgages in the UK. We're just starting to see that feed through at the moment. 80% of mortgages will be coming up for renewal in the next 18 months. So you see the immediate impact of wage inflation coming through, but the rate increases have basically occurred on a latent basis.
Hey, let's get your views on China then, because counterintuitive for money is your positive call on Chinese equities. Where are you seeing the value there? What is the rationale for wanting to add exposure to China?
Yeah, well, we're just discussing before we came on air. What we're seeing in China is we're seeing actually underlying companies performing generally better than expectations, even though the economic data is poor. But the market is acting on a uniform basis to macro level data at the moment.
So you wouldn't buy the index, you'd buy individual companies?
Yeah, I think there's pockets of value in China at the moment. Chinese companies very adaptable, and of course what we're seeing in China is very different to what we're seeing here. We're actually seeing problems with deflation in China, which is kind of counterintuitive, because they didn't give the sugar rush stimulus in lockdown that we are having to unwind now. So on a relative value basis, China looks great. It's very underrepresented in global market indices and in ETFs and so on. And again, usually the best time to invest is when you see the fundamentals in companies not being rewarded through share price movement.
So you say underrepresented in global sort of baskets, but at the same time it is represented to some extent. I mean, we saw this story yesterday about BlackRock and other fund managers are bracing for tighter oversight following a congressional probe that is basically looking at their ownership of some Chinese companies. Now, maybe taking a company by company approach is the answer then, because this is specifically about those that are in the eyes of American authorities national security threats. But are you concerned that this could provide another leg down for Chinese stocks?
Yeah, I mean, that is clearly the risk, and I think that's the reason why we haven't seen Chinese companies in aggregate moving up on the back of good news. We just see them continually reacting to bad macro data. But again, that presents the opportunity. I mean, of course, if we get further tightening and if there's further sort of sanction type arrangements put in place for Chinese companies, then all bets are off. But that is more than priced into to share prices in China now, I would say.
Okay, Haig, really nice to speak to you. Good to talk this morning. Haig Bathgate, Head of Investments at Atomos Investments. Coming up on the programme, Norway's Sovereign Wealth Fund returns over $140 billion in the first half, indicating it's back on track following one of the worst years in its history. It has a lot to do with US big tech, picking up on our last conversation. More on that story next. This is Bloomberg. This is Markets Today, 24 minutes into our trading session here in Europe for this Wednesday. And you can see a fairly flat picture actually coming through after earlier weakness on European stocks. US futures look flat to positive now. Nasdaq futures actually up by 0.2%. Now, Norway's $1.4 trillion sovereign wealth fund returned 10% in the first half of this year after one of its worst years in history. The bank is the world's biggest owner of publicly traded stocks and holds over 9,000 companies in its portfolio. For more, let's bring in Bloomberg's Oslo Bureau Chief, Stephen Trelaw, who can give us details here. And clearly this is a business, this is an investor that looms large over many markets. What drove the returns then in the first half?
So returns were driven by a 40% jump in the equity portfolio, and technology stocks were particularly strong in that sector. They delivered a return of just under 40% after a poor year in 2022. So they're benefiting from a strong demand for AI solutions and semiconductor makers. So we're seeing that feed through now. And of course, their largest holdings are in Apple, for example, and Amazon and Microsoft. So they're really benefiting from this push into technology stocks that we've seen so far this year. On the downside, we saw bonds fairly weak for the half, only up 2%, and real estate and unlisted renewable energy infrastructure were both poor performers.
Yeah, and yet they would have performed better, wouldn't they, if they just bought the benchmark? Why do they underperform the benchmark? What were some of the other wrinkles in the mix, Stephen?
Well, stocks outperformed there, which makes up the large part of their portfolio, but it was unlisted property and the renewable energy infrastructure, which really pulled them down. They're performing below expectations at the moment, given that the market is having a bit of a pullback. It's a fairly small part of their portfolio, but it's feeding through pretty strongly, as we can see. As they get more and more money from the oil and gas riches of Norway's North Sea, we should expect to see more investments in this area, and maybe that might see a good time to invest in there when the returns start to improve.
OK, Oslo Bureau Chief Stephen Treloar, thank you very much indeed. Interested to see the CEO, the head of that bank, speaking to the Financial Times and critiquing the UK government's apparent, what looks like at least, warbback from some of its green targets. And later in the day, Norges Bank Investment Management CEO Nicolai Tangen will be joining Bloomberg TV for an interview at 1:15 UK time. So do tune in for that.
Coming up, we will take a deep dive into a really fascinating story as it unfolds in UK banking. Some British Muslims have told Bloomberg their bank accounts have been unexpectedly closed. We will bring you more on this debanking controversy. The theme, of course, highlighted recently prominently by Nigel Farage. We'll get into a different angle on this story, though. That's next. This is Bloomberg. This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. Asian equities retreat for a fourth day on more concerns over China's economy. Strong US retail sales add doubt that the Fed's inflation fight is finished. UK inflation falls, but by less than expected as the cost of travel and holidays climbs. Traders hold Bank of England bets steady. Plus, Intel's deal to buy Tower Semiconductor crumbles after failing to get regulatory approval in time, dealing a blow to the tech giant's ambitions. Tom, so the Asia session was weaker, very much to do with yesterday's story, a little bit of China weakness around China themes as well. But that was all US retail sales, higher yields. Today looks a little bit different on the yield dynamic and therefore perhaps for stocks.
Yeah, the good news is bad news theme rattled the US markets yesterday. Today there's been a bit of a turnaround for European equities as we look at the first 30 minutes, of course, of the trading session. You're now flat across the benchmark after the losses at the start. The FTSE 100, even the FTSE 100 is flat, well, down about 0.1%, just knocking 6 points off at 7,383. What's the next level for the FTSE 100? Does it hold above that 7,300 line? Over in Germany, the DAX is off by 7 points, flat as well. Interesting, of course, given the components and the linkages between the German exchange, the companies there, and exposure to China. A reminder of the weakness of China's property sector, of course, falling sales for a second straight month. Yes, the PBOC came through with more liquidity, and yes, they came through with a stronger fit to try and support the yuan. But, of course, concerns are front and centre in terms of that health of that economy. JP Morgan, for example, downgrading its forecasts for growth out of China to around 4.8%, below the official figure by the end of the year. The inflation data out of the UK, of course, the BOE expectations, still traders pricing in 3 additional hikes. You had the wage data coming through yesterday, and then the CPI print core coming in slightly higher than expected. So the challenge remains, of course, for the UK on the inflation front. Let's switch it over and see how things are shaping up across these sectors. It was retail that was the only sector in the green on a day of losses yesterday, and retail posting additional gains today. Some of the earnings have come in more positive than some of the forecasts. You had an upgrade, for example, in terms of the forecast coming through from Carlsberg, though that stock is actually down after the gains that we saw yesterday before the close of trade. Retail currently, as a sector, though, holding on to gains of 0.5%. Basic Resources actually turned around, a bit lacklustre at the start of the session on concerns around China. Now a gain of about 0.1%. Energy is flat. You're unchanged on food. Travel and leisure down 0.5%. And utilities, bit of a safe haven play, just gaining 0.1%. Autos up 0.2. That's the shakeout across these sectors 30 minutes into Wednesday's trading session, Hannah. OK, so, Tom, retail, the best performing sector, which is of interest to us then. Pretty split, half 50-50, half the sector's going higher, half lower. We'll watch that session as it develops. Sort of in limbo right now with US futures, a little positive, but not moving anywhere in a hurry. Now, let's turn to a different story around financial services in the UK. The debate over debanking, as it's become known in the UK, has put fresh focus on those who have difficulty accessing financial services. Figures from the Financial Conduct Authority, the FCA, show 1 in 10 British Muslims, for example, don't have a bank account. For a deep dive into this story, let's bring in Bloomberg's fintech reporter Aisha Ghani, who has been researching this subject. Aisha, good morning to you. So, of course, this subject has had a lot of airtime because Nigel Farage focused in on it for his specific case and for the reasons that were behind his dealings with Coutts and NatWest. But you've been looking at the broader story, I suppose, here and taking a different dive into it. So what actually happens when somebody is debanked, as the phrase goes? How widespread is it?
Right, Anna. So with the people I've been speaking with, they have experienced their bank accounts being frozen, and it could be for a few days or a few weeks. And then what typically happens is that they're unable to access their money, and it means that their direct debits will bounce and they can't pay their bills. And that was what happened with Akil Ahmed from Luton, who's a former postman. And he was unable to access his bank account for 6 weeks. And then when it was reopened, when he showed his ID in branch, it was then closed again after 2 months. And his wife's joint account was shut down, and also the savers accounts for his kids.
Wow, and if you think about, in a very digital economy, how much that means you can't do as a result of a lack of access to your banking facilities.
This is far more of a scandal, quite frankly, than Nigel Farage, who was not debanked. He had a bank account in NatWest.
Well, he was offered one, wasn't he?
He
said that was a late
offered
offer,
one. So this is far more consequential. Why is it impacting the Muslim community in particular?
Absolutely. So we know that Muslims are less likely to have bank accounts. We also know that they are more likely to be impacted by poverty, and particularly in a cost of living crisis. it's quite difficult to get around without a bank account in modern Britain. I spoke to one man who 2 days ago lost his Barclays account, and it meant that he had to walk 4 miles because he couldn't catch a bus, he couldn't take the tube or get an Uber. And we're talking about people who are on a less socioeconomic spectrum in this country, and it just compounds them in multiple ways.
OK, and how have banks responded? Because, you know, they have responded around the Nigel Farage case. I imagine that there are various angles and sort of threads to the debanking story, and they all require different kinds of analysis. But what have the banks been saying?
Indeed. Well, it was earnings season recently, and most of the bank chiefs told us that they don't close down accounts, they don't take personal or political beliefs when they close down accounts. But we know that the FCA has requested an investigation and will be asking banks how many people have been debanked and why, and that will be coming next month.
So important data we can get from that particular investigation then, perhaps. Aisha, thank you very much. Bloomberg's Aisha Ghani with that, the latest on that developing story. Let's check in on the markets then, the individual stocks that are on the move. Joe Easton has a briefing. Joe.
So Admiral is the best performing stock in the UK today after the motor insurer reported some strong pricing, managing to push up their premiums and not seeing a decline in subscribers according to their insurance business. Marks and Spencer's gaining for a second day, up around 12% in the past 2 sessions now. Deutsche Bank upgrading their price target following that strong earnings guidance from the UK retailer yesterday related to their food business. Meanwhile, over in Denmark, Demont having a good session. This is the maker of hearing aids. They've upgraded their guidance as well. We've also thrown in Alcon. This company does contact lenses and also glasses. So as the producer points out, we've covered eyes and ears today, so we thought we'd get that one in there as well. Then we're going to flip over and look at the losers, the red screen. So Stellantis, the Italians were on holiday yesterday, and there is a threat of a strike in the US hitting firms like Stellantis, the owner of Peugeot, also General Motors as well. All those stocks in the US have been falling, and we're seeing Stellantis reacting as that market reopens this morning. Then I've brought up our old friend UBS. Now there's an interesting note out from Citi today, quashing any hopes that they could spin off the Credit Suisse unit. They say they've had inquiries from investors over whether that could happen, but they say it wouldn't be politically viable, and they are quashing hopes on that one. That one down around 0.3% in Zurich. Then NKT, this is an electro components company, cutting their guidance, the worst performer over in Denmark today, falling more than Carlsberg. Now, the reason Carlsberg is down, even though we had most of this earnings report yesterday, is that the volume decline is much worse than analysts had predicted. However, the CEO spoke to Bloomberg today, and he said he's much more focused on revenue than volumes. Have a listen to what he had to say.
Yeah, what we have done over the last half year is indeed to raise the prices in line with the cost inflation we encountered. We have done that across our territories, but especially, of course, in Europe. And hence you see a net revenue per hectoliter, which is roughly 10% higher than before. And by that we have been able to ensure that we would remain to have the gross profit that we needed in order to further develop our business and also to invest further in our brands.
So that was the Carlsberg CEO there speaking to Bloomberg. As I say, that stock down around 2.5% over in Copenhagen, removing all of the gain that we saw yesterday as they pre-released their earnings guidance, up their guidance. But as I say, the volumes weaker than expected hitting Carlsberg today. Yeah,
volume growth of just 1% versus the estimates of, I think, a little over 1.2%. Joe Easton, thank you very much indeed, of course, from our equities team. Now, coming up, Intel's deal to buy Tower Semiconductor, well, that crumbles after it failed to get regulatory approval in time from Beijing, the geopolitics and the consequences for a struggling Intel. We bring you the details next. This is Bloomberg.
Our business historically has been driven by men. Today, 56% of our customers are actually women on our website and our stores. They represent less than 30% of our business. So that's a massive opportunity for us. And I think as we get to her, understand her better, develop the right products for her, present the products in a way that resonates with her, which may not be the same way as for men, that's a big opportunity for us.
Ralph Lauren's CEO, Patrice Louvet, there, speaking to Bloomberg's Francine Lacroix. And you can watch the full interview with Ralph Lauren's CEO tonight. That's at 9:30 p.m. New York time, and in Europe tomorrow at 6:30 p.m. London time. A breaking head for you now, a red head across the Bloomberg terminal. China asking some funds to avoid net equity sales as markets sink. For some, this will smack of desperation from China's policymakers. They are asking funds to avoid net equity sales. We had the reporting yesterday, reports that they were considering a cut to stamp duty on stock sales as well. In the session today, the benchmark CSI 300 fell 0.7%, with all the concerns about deflation, about soft export sales, about, of course, the real estate market, and a reminder today of property prices falling for a second straight month, and that weighed on equities. This, the next step from policymakers trying to shore up these stock markets.
Yeah, absolutely. After we saw the PBOC trying to do their bit yesterday in terms of lower interest rates, which many have expressed the view didn't do much to shore up expectations for that economy. Let us get to some of the other top stories that are being well read on the Bloomberg terminal this morning then, Tom. The philanthropic organisation that controls most of the $25 billion in assets in George Soros' family office is set to end most of its operations in the European Union. As part of a retrenchment under new leadership, the Open Society Foundation told Bloomberg it's introducing a new operating model. The changes also come as the foundation cuts headcount by some 40%. The Vietnamese EV maker VinFast soared in its first day of trading in New York after going public in a SPAC deal. Shares gained 255%, giving VinFast a bigger market cap than GM, Ford and BMW, or BMW, sorry. However, just 1.3 million shares are available for trading, with most locked up by the company's founder and his family. European natural gas futures spiked yesterday for the second time in less than a week. They were also up a little in early trade this morning. That's as tensions run high over the possibility of strikes in Australia that could severely tighten the global market for liquefied natural gas. Discussions between union officials and one of the two companies operating the affected facilities yielded no firm outcome to the labour dispute. BlackRock is among companies bracing for tighter oversight in the United States following a congressional inquiry into investments in Chinese companies deemed to be national security threats. The Biden administration signed an executive order last week limiting U.S. investments in China in key technology industries. Vanguard, Fidelity and DWS also manage funds with investments in China, some of which are the type that Congress is investigating. They're one example, Tom, of the tensions geopolitically between the U.S. and China in that executive order from the Biden administration, but I know we're dealing with another this morning.
Yeah, well, talking of those geopolitical tensions, there is potentially, we don't know for sure, an overlay here in terms of the scrapping of this deal by Intel to buy Tower Semiconductor, which is an Israeli company, that dropping close to 9% after Intel terminates that deal because they did not get approval from Chinese regulators in time for that deal. The deadline was the 15th US time. So they've terminated that deal, Intel and Tower Semiconductor, which has part of its businesses around foundries. That is dropping around 9% on the back of that news. It would have been a $5.4 billion deal, and it was seen as important for Intel as it tries to switch focus to some of those more high-tech stocks and build out their own foundry business. So that is the move there from Tower Semiconductor. We keep across that story for you, of course, throughout the day. Back to the consumer in the US now. Home Depot earnings beating estimates, suggesting US house improvement spending is actually performing slightly better than expected. Bloomberg's Simone Foxman, she has the details.
Strong retail sales numbers up 0.7% in July, as well as better than expected earnings for Home Depot kick off a busy week of retail big box earnings. They weren't as weak as most analysts anticipated, with comp store sales falling only 2% and revenue up at $42.9 billion. CEO Ted Decker pointing to some weakness in really big expenditures, those big ticket $1,000 plus items like appliances, like patio furniture. But it's important to note that the Home Depot consumer is a little bit different than other consumers in the U.S. economy. Their top consumer is homeowners. They're also very exposed to the pro market, so contractors, and they're buying supplies for new homes. And in some ways, a little bit more reflective of the housing market than overall shopping. But we'll get a better gauge of that when we get Target earnings. And then later in the week, we are looking forward to earnings from Walmart, which is trading near record highs as it's been able to capture a wide swath of the consumer base. In New York, I'm Simone Foxman for Bloomberg News.
Let's talk about what's happening in global markets this morning. Simon White joins us from our Markets Live team. And Simon, let's go first to what's going on in gilt markets, shall we? Because we started the programme an hour and 48 minutes ago with the latest on the CPI numbers coming out of the UK. And it's interesting it seemed as if the gilt trade took a while to settle down this morning. We've got slightly higher yields, but I guess the market responded and jumped on the wage data of yesterday, so there was less to play with today. How did you interpret the CPI print we got this morning?
Obviously we expected a drop, which we got because of the energy price cap. I always emphasize the fact that inflation is a very lagging indicator, so it's telling us that something that's already happened. But the Bank of England obviously still pays attention to it, and that's why it's still important from a market's perspective. So we were, it came in slightly higher than expected, and obviously leaves the Bank of England in a bit of a bind because the growth data isn't as bad as perhaps people expected, but there's still pockets of concern in the UK. I mean, insolvencies are near a 15-year high. Leading indicators for the housing market are very poor. So despite the sort of optically better than expected growth numbers, which still aren't great, they're just better than expected, it still doesn't leave the UK in a particularly great place. And on top of that, you have the inflation. And so that's going to keep the Bank of England tightening for now. But I think the risk is that they ultimately do tighten too much.
OK, so that's the risk. Do you think, Simon, they go 50 basis points at the next meeting with a surprise, big number, big rate increase to kind of lock this in and tidy away the inflation picture?
I think on balance, they probably won't. The market's priced in maybe a 20-30% chance of it happening. I think they did a surprise or a 50 not that long ago. I think the balance of risks is changing. And remember, by the way, the Fed is clearly very close to the end of its hiking cycle for now anyway. And that really makes other central banks' jobs a little easier. So I think on balance, they probably won't. But as the Bank of England, so quite honest with you, I don't actually know.
So all things, various outcomes could occur. Let me ask you about what's going on in treasuries and broader sentiment, I suppose, on markets, the link between treasuries and stocks. The story of April does seem to have been dominated by weakness in stocks, weakness in risk assets on the back of concerns about higher yields. Today we see something different. I mean, risk appetite really turned around in the last hour or so. US futures ticking higher, NASDAQ futures up 0.3%, and we see yields coming down. Where are you positioned on how that story develops, Simon?
Look, in the short term, bonds are oversold, so you'd expect some sort of comeback. We saw a little bit of that yesterday. But the genie's out the bottle, really. I mean, the market is now concerned about supply risks, and supply risks ultimately mean inflation risks. In a much longer term perspective, if you have persistently big fiscal deficits, which now look to be a feature rather than a bug, and not just in the US, by the way, but in across the Western world, the pandemic really just accelerated that. In a world of large fiscal deficits, then inflation is a longer term risk, and it tilts the whole balance. Clearly the long term bull market in bonds, which began in the early 80s, is now clearly over. The situation is very different now. The inflation genie is out of the bottle, and governments are going to have to borrow and are needing to borrow much more than they had done in the past.
OK, Simon, thanks very much. Simon White from our Markets Live team. Remember, you can get up-to-date analysis and insight from Simon and the rest of the Markets Live team. Mark, of course, running that team. MLIV Go is the function on your Bloomberg terminal. Now, in just a few minutes' time, we'll be talking to Gareth Davies, Exchequer Secretary to the UK Treasury, about the latest stickier-than-expected inflation numbers. They are coming down, but still work to do. Wage growth and the outlook for the UK economy also in focus. Stay with us. This is Bloomberg.
Welcome back. Intel's acquisition of Tower Semiconductor has fallen apart after it failed to obtain regulatory approval before a midnight deadline in California. Joining us for the details out of Hong Kong is Debbie Wu, who leads our North Asia tech team. Debbie, why did this deal fail to go through? Is it all about geopolitics?
It is very much so. So Intel says that it is terminating the acquisition deal because it failed to get the regulatory approval. So that means Beijing has not signed off on the deal before the deadline for the transaction ended at midnight California time earlier today.
OK, and there could be a geopolitical angle to that then. What does this mean for Intel's future, Debbie?
Intel's CEO Pat Gelsinger has been trying to bring Intel to enter the foundry business and compete with Taiwan Semiconductor Manufacturing Company and Samsung Electronics to better to sort of grow a revenue stream for the U.S. company. But due to the failure to acquire Tower Semiconductor, this could sort of become more challenging for Intel to get into the market. So we'll have to wait and see whether Intel comes up with a new strategy to better compete with TSMC and Samsung on the foundry front.
Debbie, thanks so much. Debbie Wu in Hong Kong with the latest on that chip deal that was and doesn't look as if it will be. That is it for Markets Today. You can catch insights from us, of course, and the Markets Today team by going to the front page of the Bloomberg UK website or typing TLIV Go into the Bloomberg terminal. Just quick check on the markets. We're actually a little more positive, Tom, than we thought we'd be. The FTSE 100 underperforms. Other European equity markets edge higher. US futures higher. Nasdaq futures up by 0.3%. Yesterday was derailed from a stocks perspective by the retail sales print. Today we've got yields falling. Does that add some room for stock markets to go higher? It seems to be the short-term dynamic at least. The Pulse is coming up next. This is Bloomberg.
news and market movers. This is The Pulse with Francine Lacqua.
A very good morning and welcome to The Pulse. I'm Manish Kranny in Dubai. What's coming up on today's programme? Well, Chinese authorities have asked some investment funds to avoid being net sellers of equities as the right deepens in the country's financial markets. More weak data from China pulls Asian stocks lower for a fourth session. UK inflation remained higher than expected last month, with climbing costs for travel and holidays. Investors now bet on further rate hikes from the Bank of England. And Neil Kashkari says the Fed is a long way from cutting rates as US retail sales show consumers are alive and kicking. A very good morning to you. Good afternoon if you're tuning in from Asia. This is The Spectrum. Europe is suffering immunity from the China angst and woes. Look at that. The European map is still just eking out some gains. I can tell you this. Volumes are 33% below where they are normally at this time of year, as we see growth outlook for China being slashed by JP Morgan to 4.2% next year. Immunity at the moment. I had Jane Foley with me this morning talking about a lower euro on the back of the exposure. The exposure is Europe to China, not US to China. And our headline is, of course, there's more angst in shadow banking. The authorities now ask China to some funds to hold back on their equity sales. This state of play, natural gas is ramping higher in Europe. Market jitters really about Australia. Australia, 10% of the liquefied natural gas market is in Australia. We've got walkouts and we have people on strike down there. So we saw the market explode higher by some 15%. We've come back now and dropped. Wheat is on the up. We put that in there for you, up 0.8%. There's been attacks on the Danube overnight, again in the Odessa region, so there are concerns about supply there. Now, 10-year yields are falling. We'll get to Valerie Teitel in just a moment. Now is the time, according to Stephen Major at HSBC, who says, go up that curve, get yourself long those bonds. 30-year paper, by the way, for example, above the level that we saw in 2011. You're looking at this year's highs on 10-year paper, but we are trickling back down. And cable trades at 127.41, up 0.2%. I would say a fairly muted reaction to an inflationary narrative, which some would say is stuck and perhaps even in a spiral. We have the worst inflation in G7, CPI 6.8%, and that is something to be concerned about. Let's focus in on 10-year paper, 30-year bonds. They rose to the highest level since October yesterday. We had those stronger than anticipated retail sales for July. That reinforces the narrative that the Fed may have to raise rates further. Valerie Teitel is with us. So, Valerie, we saw this spike and now roll on some of these yields. The narrative is the Fed may still have more to go, according to Kashkari, but there is also the narrative building by some of the major houses, Stephen Major being one of them. Now is the time to enter the valley of duration. Good morning.
Good morning, Menace. Yes, a lot going on in the Treasury market. My eye is surely squarely on where these real yields are going. It really was that retail sales beat that drove a lot of the move yesterday, because retail sales, Menace, feeds directly into GDP. That controlled group feeds directly into GDP. Consumers make up 2/3 of GDP spending in the U.S., which is just boding ever well for this third quarter GDP print. We saw JP Morgan seeing upside risks already to their third quarter call. And the Atlanta Fed now, their GDP forecast for the third quarter is now on a 5 handle. So this U.S. economy isn't turning, I guess, negatively anytime soon. That's what the data told us yesterday. And back to Stephen Major's point on maybe now is the time to go long the bond market. I would say the I guess, opposing argument to him is if the U.S. does enter a recession, if we do get this growth slowdown, normally what comes alongside that is a surge in government spending and a surge in Treasury supply. If you do think that this latest real yield move has been more driven by supply and demand dynamics more than anything else, perhaps actually we could enter a recession and see yields not fall as much. Yes, they would rally in the front end if we price in Fed hikes, but if more government spending is on the cards, if a bigger and
swelling deficit from the U.S. government is in the cards, that could keep the longer rates, longer yields in the Treasury yield curve quite supported.
Okay, well, two sides to a market. And Major's note this morning, of course, talks about making the case for the man of straw. Valerie, thank you very much. Valerie Taital. So we've had more data from the United Kingdom. The annual inflation rate fell last month, but less than expected as the cost of travel and holidays climbs. The latest figures add to the case that the Bank of England may have to raise rates again. But some Treasury advisors are concerned that the Bank of England is at risk of overdoing it and pushing the UK into an unnecessary recession. Let's speak to the government minister now. Gareth Davies joins me now, the Exchequer Secretary to the UK Treasury. Gareth, thank you so much for joining us. I mean, if we look at the last 24 hours, wages growth blows out by a record amount. You're looking at services inflation, the highest since 1992. Are we losing control of the inflation narrative? Are we in some kind of a doom, sticky loop on inflation? Good morning.
Well, good morning. Thank you very much for having me. Today's figures, as you were reporting, for inflation has come down significantly. I think that'll be met with some relief by a lot of families and businesses across the country. We've seen a significant reduction. I think it's the lowest level of headline inflation since February last year. But as you allude to, we're not out of the woods yet. We've got a long way to go and we've got to stick with the plan. I think inflation reached nearly 11% last year, and while it's come down significantly from that point, it's really incumbent on the Treasury, on this government, to stick with the plan, to make sure that we're making responsible public finance decisions and that we make sure that fiscal policy is aligned with monetary policy at our independent Bank of England. We'll continue to do that. And we're certainly not complacent despite the significant reduction announced today.
Look, yes, it has dropped. There's no doubt about it. But you have the worst inflation in the G7. The Office of Budget Responsibility says that you're in a very tricky footing at the moment. Is this government prepared to go further and cut services, cut costs? I mean, the OBR says you're going to need to do tax rises and cuts equivalent to 4.4% to do that, to tame inflation.
We've got a plan that includes ensuring that inflation is our number one target, in terms of priority for the Prime Minister, getting that down by a half this year. Most of the forecasters believe that we will see that happen. The IMF, OBR and Bank of England all expect inflation to come down significantly this year. You talk about other countries. It is a global phenomenon driven by post-pandemic situations on supply chains and, of course, the war in Ukraine. So we're not alone in having high inflation. It is coming down. We need to stick with that plan. One of the things that we can do is ensure that our fiscal policy is aligned with the Bank of England's monetary policy. That means taking tough decisions when it comes to public sector pay, for example. We've taken action to hold down energy prices with frozen fuel duty. So we are taking what the IMF have called decisive action. We just need to keep going with that and we'll see inflation come down overall.
Andrew Bailey, you talk about alignment between monetary policy and fiscal policy. Andrew Bailey has made it clear that higher inflation, or inflation spiral, as it would appear that we are in, is going to mean higher rates from the Monetary Policy Committee. Are you concerned that higher rates could invoke a pretty hard landing, a recession?
Well, nobody wants a recession. We've been very clear that critical to ensuring that we can grow our economy and avoid a recession is to get inflation down. And the Bank of England have been clear that in a year's time, if we stick with the plan, inflation will be around 3% while avoiding a recession. We've seen a major upgrade to our growth forecasts by the IMF, OBR and the Bank of England. You know, I remember not so long ago, a lot of the forecasters were saying that we would enter a recession by now. That hasn't happened. But we do need to ensure that the driving factor here is getting inflation down. We do need to align fiscal policy, as I've outlined, with the Monetary Policy Committee's decision on interest rates.
What does that actually mean? What does that actually mean in terms of aligning aligning your fiscal policy. It's a very broad, grandiose term, if you will allow me, but it means something a lot more severe, doesn't it, Gareth?
It means the action that we've already taken, for example, the energy price guarantee, which held inflation in energy prices. The OBR said that would knock about 2% off inflation by holding the duty on fuel, for example. We've seen fuel inflation start to come down. It's taking that part, the decisive action on those factors, while also not making decisions, not taking action that would exacerbate inflation, for example, by increasing borrowing and spending at unsustainable levels, by making decisions on taxation that would fuel inflation. So it's part action that the IMF have said is decisive action, while also making sure that we don't exacerbate inflation. That's what I mean by aligning the tough decisions that we've got to make in the Treasury with the tough decisions that the Bank of England are making on monetary policy.
I look at debt to GDP. Your debt servicing costs are exploding, as are other nations around the world, before you caveat that for me. But debt to GDP is over 100%, Gareth. We haven't seen that since 1961. There hasn't been much achievement in terms of reducing that. I suppose the question that we here have got to ask you is, are we in a more perilous position for the government bond market of the United Kingdom than we ever were under Liz Truss? I mean, this is a fairly brutal statistic for you to deal with. Are you concerned about a strike in owning UK government debt with these debt to GDP numbers and it's worsening?
Well, you're right to point out the level of debt that we have in this country, but it's also important to highlight what has caused that high level of debt. We had a global pandemic shock to our economy, which required the Treasury to step in with hundreds of billions of pounds of support to ensure that businesses and individuals and families could get through the worst of that crisis. And then we came out of COVID to have an energy shock caused by the first war in Europe for decades. So we've stepped in with about £94 billion of energy support for businesses and individuals as well. So it's no surprise that debt is high. What we've got to do now is get inflation down, make sure we can grow our economy, invest in our people, garner business investment to get that economy growing, so that we can get the debt down. We are not complacent by any means. You're right that other countries are facing the same dynamics, and they are because these are global factors that have caused this situation. We've just got to keep going with our plan to act responsibly when it comes to public finances and make sure that we're boosting investment wherever possible.
Gareth Davies, Exchequer Secretary to the UK Treasury, thank you for joining me this morning. Coming up on the show, Norway's sovereign wealth fund returns over $140 billion in the first half. We look at how it got back on track following one of the worst years in history, right here on Bloomberg. Norway's sovereign wealth fund has seen a 10% return of $143 billion in the first half of the year, driven by tech. The gains there indicate that the fund is back on track after one of the worst years. Its largest holdings are Apple, Microsoft, along with a number of huge tech names. Now, it chimes with Bank of America, the survey there, which found that global fund managers are now the most overweight technology since December 2021. Hannah Gooch-Peters, global equity investment analyst at Sanlam Investments, challenges that base case. Ms. Peters, good morning. So the rest of the world is long, and long can be on tech. But you have a warning on mega stock trends. You're a little bit suspicious. Can you qualify that for me?
Morning, Manus. Well, I think that when you see such a dramatic move in many of these names, of course, the largest names in the world, they're all trading on very expensive valuations. And I think now is the time to be cautious. I think many investors have long forgotten the pullbacks that we saw last year. Of course, names like Microsoft, like Amazon, for example, had dramatic pullbacks last year because they were all trading on exceptionally high valuations. And I think that if you are now trading on a, say, 3.5% free cash flow yield in this environment, I think now is the time to just be cautious and perhaps reduce those positions, which is what we've been doing.
Bill Gross was pillaring the bulls in the bond market and lambasting the bulls in the equity market. And he said, look, the premium, the equity premium is not there. Do you think that there are cracks and fissures, as it were, appearing in the yield in equities relative to bonds? Does that have any merit for you in your world? I'm just going to grab the chart for the dividend yield to bond yield. Are you with Bill on pillaring the bulls?
No, I completely understand the argument, but I think also those investors that have been invested long-term in bonds, unfortunately, especially due to last year, haven't done particularly well in terms of returns. And I think in an environment where you've also got inflation, those real returns can be a challenge. And on a headline level, yes, the equity market does look expensive, particularly in the US. And like we said before, that's largely driven by those large cap names that are trading on those high valuations. But this is the time to look under the hood, underneath that headline level, and you'll see that because we've had such a bifurcation in returns this year, that there are actually some really exciting growth opportunities coming out at more reasonable valuations, and those names that have lagged those large sort of headline numbers that have really driven the market. So yes, on an overall level, equities versus bonds not looking quite so appealing, but underneath the hood, underneath that headline layer, I think there's some really exciting opportunities out there.
Look, we're getting more and more. There is the equity risk premium, by the way, relative to bonds. And as you can see, that is coming back to the average level and indeed below that. Let's shift our narrative to China. I mean, we've written a great deal. Fitch may reconsider the credit rating. There's concern now. There's narratives and instructions to the asset management community: don't sell as many equities. There's concerns about shadow banking. There's concerns about retail sales, concerns about fixed asset investment, concerns I could go on. And yet you are quite bullish. Long-term growth, 30%. New room for pipeline, 6% compound growth in cash flows, etc. You are more bullish on China than the headlines are at the moment. So what is it? When all the rest of us are fearful, you're greedy?
So I think the example you're using there, of course, is Intercontinental Hotels Group, which is a UK-listed business, but it's got, we think it's going to have about 30% of its new room exposure in China. What we've noticed in the market is that the Chinese market is about flat this year, if you look at it in dollar terms. We've seen some massive pullbacks, of course, last year exceptionally weak. There is, again, a huge difference in returns between those companies that rely on China as a growth engine, and Intercontinental Hotels Group is one of them, for example. But other examples would be something like L'Oreal or Louis Vuitton. They have China as a growth engine. They've done exceptionally well this year. So those companies that are actually listed in China, there's been a lot of weakness around there, I think, due to the sentiment. But companies that are reliant on that growth engine are actually doing really well this year. There is a huge difference, though, you have to be very careful with your stock selection, I think, when you're looking at China. A company like NetEase is up close to 40% this year. It's an exceptionally high-quality company looking at that growth in online, that mobile gaming. But then you've got to stay away, I believe, from real estate and from banking exposure in particular in China.
And sorry, I misrepresented that, of course. I should have qualified it and said that there are names, and you quite rightly corrected me, IHG being one of them, which has a huge China exposure. But when you see those mega macro headlines on China, do you think how do you think the reaction by Europe, for example, Europe's quite steady this morning on really gushing headline after headline after headline, which is fairly turgid on China. Why the immunity or impunity, if one can use that phrase at the moment, on equities to what's going on in China? Do you think positioning is light in China?
I do think positioning is light in China. I too was also surprised by the sort of strength in some of these names, particularly with their Chinese exposure in Europe this morning. I think that there is a lot of weight put onto where companies are listed, and that's something that we really try to ignore, to be honest with you. We're looking for where companies generate their revenues, and I think that's what's really important. And like I say, companies like L'Oreal, like Louis Vuitton, have this massive Chinese exposure, sort of 40-odd% of their revenues, and it's a real growth engine for them going forwards, but they are trading on exceptionally high valuations. They seem to be immune more so to this Chinese, to the bad news in China. They're looking through that. And I think that sort of bad macro vocabulary, if you like, can actually be a good entry point into names. I think we have to try and look past short-term news and invest in companies that have that long-term structural growth opportunity.
Hannah, thank you very much. Hannah Gooch-Peters, the global equity investment analyst over at Sanlam Investments. Norge Bank Investment Management, I should say, the CEO, Nikolai Tangen, will be joining the TV team, the Bloomberg TV team. That's 1:15 UK time, right here on Bloomberg.
Yeah, what we have done over the last half year is indeed to raise the prices in line with the cost inflation we encountered. We have done that across our territories, but especially, of course, in Europe. And hence you see a net revenue per hectoliter, which is roughly 10% higher than before. And by that we have been able to ensure that we would remain to have the gross profit that we needed in order to further develop our business and also to invest further in our brands.
The Carlsberg CEO there after the brewer said consumers are still Chinese authorities have asked some investment funds to avoid being net sellers of equities as the right deepens in the country's financial markets. More weak data from China pulls Asian stocks lower for a fourth session. European stocks fluctuate. UK inflation remained higher than expected last month, with the climbing costs for travel and holidays. Investors now bet the BOE rates are steady. And Neil Kashkari says the Fed is a long way from cutting rates as US retail sales show consumers are alive and kicking. A very good morning. Welcome to The Pulse. I'm Manish Krani in Dubai. You've had blowout inflation numbers in the United Kingdom, and that really is something for us all to consider. Well, the Chinese shadow bank, Zhongong, has missed payments on dozens of products, indicating troubles at the embattled lender are even deeper than previously known. the firm's liquidity challenges underscore the problems in the property sector, where new home prices in China have dropped for a second month in July. Joining me now is our China government and economy editor, Jill DeCease. Jill, look, there's lots of headlines coming across here now. Talk me through the scale of the unfolding crisis around the asset management and shadow banking at the moment.
Yes, Manna. So ultimately what you really have to remember here is that this trust industry within China, this is a $3 trillion industry in China. And a lot of the concerns that are unfolding, both at this bank, which is affiliated with a much larger one, is that it's sort of creating this idea that there could be potentially some contagion risk from a lot of what we're experiencing in the property sector right now, sort of spilling over into the financial sector. So as we understand it, some of payments affiliated, or some of the investment products affiliated with these companies, these trust companies, are related to real estate. And then, as we know, real estate problems within China have been at this point a years-long concern, and really kind of worsening within recent weeks and months. I mean, we've been spending a lot of time on this program and other programs talking about a lot of the problems at Country Garden, one of the nation's largest developers, which is experiencing its own liquidity crunch. And then we also know that there's these continued issues playing out across the housing sector at large. We just got some pretty weak home price data out of China this morning, some very weak property investment data yesterday. So all of this kind of combines to tell us that we still have these really, really deep-seated concerns about not just the property sector, but also how it's kind of spilling over into potentially other industries, as you see here.
Now, look, I mentioned it through the show. You've got JP Morgan downgrading growth this year and next year, 4.2%. Barclays also slashing their growth targets for China. How much of that is new information? What is it in these downgrades that perhaps I need to focus on more closely?
So, look, Manus, I think the important thing to remember here is that, with these downgrades, JPM going to 4.8%, Barclays going to 4.5%, we're starting to see economists consider that China might even miss what was ultimately considered a very conservative growth target that they set earlier this year. Remember, back in March, a lot of economists were even more optimistic about what the state of the economy looked like, what growth would look like through 2023. JP Morgan at one point, I think, had a growth estimate of 6.4% for this year. Now you're starting to see these banks kind of slide under what the growth target was for the government. I mean, maybe that indicates that, the government in setting that conservative target was trying to pace everybody this year in terms of what the extent of the scale of stimulus would look like, how all of that would unfold. But I think now we're starting to see some fears over whether, we can really hit those targets, how we have to reorient our calculus around China, and then ultimately how we have to kind of keep in check our expectations for support and further stimulus this year.
Okay, Jill, thank you very much. Jill DeCease on the China growth downgrades. Let's turn our attention to the crypto market. According to the latest Bloomberg data, Bitcoin's 90-day vol has dropped to the lowest since 2016. It's an unusual stretch of calm for the digital token. It's hovered around $29,000 throughout most of August. Let's get to Adam Back. He's the chief executive, the co-founder of Blockstream, a leading provider of blockchain technology. And famed in your world, famed in the Bitcoin world. What will rock me out of this slumber? Volatility, the lowest since 2016. There's a deafening silence. What's going to rock Bitcoin above or below the 29,000 level? Adam, good morning.
Good morning. Yeah, I guess August is a quiet month in Europe. Lots of people on holiday. But, I think Bitcoin tends to surprise people by, they get bored and then suddenly something dramatic happens. So I think just leave it a while and something will happen.
Well, event risk is always there, isn't it? There's a halving event to come, probably in the spring of next year. What impact will that have?
It's something that there's some debate about whether it's priced in the market. Some people will say, it's priced in, but I think because of the generally high volatility, other than the last month, it's quite hard to price in. And it also punctuates the 4-year halving cycle, sort of economic cycle of Bitcoin. And historically, Bitcoin's done well. Within 6 or 9 months after the halving, there's been a sort of price appreciation part of the cycle. Now, this time,
so what do you think is possible?
Well, I think it's possible that we get to, a new all-time high, like 100,000 or more, even before the halving, simply for the reason that the last few years have been kind of a depressed market in general and in the crypto market through, a number of bankruptcies and DeFi failures, things like that.
Do you really think $100,000 is achievable in Bitcoin before the halving event? There's no fear that you're very resolute on that?
Yeah, I mean, actually, I infamously took a small bet with somebody on Twitter on that. It was just some conversation about whether it would happen or not. And this fellow said, well, let's bet on it. So I let him pick the price. And so we're on. Let's see if it happens.
You got skin in the game. Good man. Look, your company, you raised $125 million. You come from the mining industry, the mining sector. $125 million, do you need more money? What are you going to do with that money, briefly?
That was just the latest fundraising activity. In total, we've probably raised about 400. We've been around since 2014. So it's primarily, there's two parts of it. One is layer 2 Bitcoin technology, like Liquid, which is a securitization layer for Bitcoin, and something we issue investment products on. And the other part is hosting. So we provide hosting for institutional miners, so people like Fidelity, we host all of their miners in our facilities. It's kind of like co-location for mining, people doing mining at fund level.
I mean, just on that mining narrative and the facilities they're in, do you see a continued bottleneck in terms of the infrastructure in mining? Where are we in that cycle?
Yeah, I mean, actually, that's the subject of an upcoming financial product from Blockstream, but basically, going back a couple of years, there was a shortage of miners going into the Bitcoin bull market because the price appreciated, mining profitability appreciated, and the manufacturers couldn't produce them fast enough. At this stage in the cycle, there's actually a surplus of miners and a shortage of ready-to-use hosting infrastructure. And you have to bear in mind, a lot of the Bitcoin ecosystem is underfunded, undercapitalized. So people are using leverage, which tends to exacerbate volatility as well.
Now, I said that you're famed in your own world, and of course you are. You're one of the original gangsters. I think that's what you referred to. What we're all curious to know is, obviously, Satoshi Nakamoto apparently communicated with you in 2008. Have you spoken to this fabled person recently? What do you think he or she would make of Bitcoin now? Do you think that there'd be 100,000? They'd agree with you 100,000 is on the way? Have you communicated? Have you had any communication?
No, I don't believe he's been heard from since something like 2011, and I only communicated via email at the time. So, I mean, I guess we don't know exactly how many Bitcoins Satoshi has, but it would make him, probably one of the 20th wealthiest people in the world at that kind of price.
Okay, so radio silence. Well, he knows where to catch you. You're obviously making bets on Twitter. Well done. Good to have your call this morning on the miners and indeed on the halving event and where prices will go. That's Blockstream's chief executive and co-founder, Adam Back, on Bloomberg. Coming up on the show, Open Society Foundations ending most of their operations in the EU. More details behind the shift in direction by George Soros' charitable organisation, The Moves, on Bloomberg. Big tech matters. We know that. Breaking news on the Pulse. I'm Manus Cranny in Dubai. Tencent has just delivered their numbers for the second quarter. Now, the revenue has missed. So the top line revenue has missed 149.21 billion yuan. That estimate out there was 150, just under 152. Now, the issue is this, is that on an adjusted basis, the net adjusted income is 37.5. So that actually is a beat. In the very first flush, we dropped by over 1%. So the revenue is a miss. Value-added services revenue is 74 billion. Just digging through here. They've cut their total of employees by just over 1,700 in the second quarter. They hire 104,000 people. Just think about WeChat. Think about the platform. Think about the network that they cover. 11% growth in revenue matches the March quarterly growth. But, the top line miss is small, one could say that. We have an MLive blog for you there. Our editors and reporters are contributing throughout, dissecting the numbers from Tencent. The stock's up 3.65% year to date. Do you want to be long tech in China? That is the question. Revenue up 11% year on year, but down 1% on the quarter. We'll leave it there. The philanthropic organization that controls most of the $25 billion of the assets in George Soros' family office is set to end most of its operations in the European Union. For more on what that means, Maria Tadeo joins me now. So this is the end of a generation, really, of Soros in Europe. Is this a downsizing? Is this a statement? How do you walk away? How do you take away the walk away?
Absolutely, Manus. And this is a very significant story for many reasons. To some extent, as you say, the Soros Foundation, Open Society, they say they will terminate their operations in the European Union this year, and the operations that they keep and decide to keep will see extremely limited funding. Now, the reason for this, they argue, is a strategic change in their priorities. A positive spin they're given to this is that, to some extent, the European Union already provides the tools and the platforms for ideas like freedom of speech and democratic values. So therefore, the funding from the foundation may not be needed as much, and they want to switch into other countries like perhaps Ukraine and Moldova. But Manus, you alluded to this. It is to some extent the end of a chapter here, because George Soros has a very personal and deep connection with the region, particularly with Central and Eastern Europe. Let's remember, he is Hungarian by birth. He was a big critic of communism and has been deeply engaged in the political debate in that region. So now pulling back from it, obviously, it carries a very almost sentimental to impact on this region. And we see this pulling back, which they say is strategic, again, is thin on the details, but obviously politically significant too.
Well, what are the political implications, Maria? I mean, we just had a massive graphic there, $19 billion spent. But is there a political undertone as well on this withdrawal, or scaling down? Maybe we should use the word scaling down.
Yes. And already, by the way, when you talk about the downshift and the scale down, we knew that it was happening to some extent because Mr. Soros passed on control of the foundation to his son, and we knew that job cuts anyways would happen and would take place. The significance of this is that most of the operations, in theory, would cease to exist. But it is political, as you say, because this is not just any foundation. And we know that Open Society and Mr. Soros himself is a real political battleground in countries like Hungary, but also to some extent too Poland. And we know there has been now for many years a political fight between Mr. Soros and the Hungarian Prime Minister Viktor Orban, who has said that he's not doing charity, that he's not doing philanthropic work, that this is a political network that tries to decimate traditional Christian values. Of course, there has been a lot of criticism about what Viktor Orban means by those traditional Christian values. So again, is that clash of the two, particularly in his native country of Hungary. The other flip side to this, just very briefly, is that a lot of the organizations and the platforms and the civil platforms that work with open societies, what they could argue is that if they receive less cash, actually that is detrimental to the values that Mr. Soros says he has stood for his life, is that, well, obviously democracy and liberal values, if you don't have the funding, it would make it very difficult for some of these NGOs and civil platforms to continue their operations.
Okay, Maria, thank you very much. Valuable insight there into George Soros's move on funding in Europe. Maria Tadeo. European natural gas futures, they're lower this morning after spiking in the first flush for the second time in less than a week. That's as tensions run high over the possibility of strikes in Australia that could severely tighten the global market for liquefied natural gas. Now, the discussions between European Union officials and one of the two companies operating the affected facilities yielded no firm outcome to the labour dispute. Ukraine's energy minister says the country is preparing for another hard winter as the war with Russia grinds on. It's an exclusive conversation with Bloomberg. German Galushenko told us Kyiv is expecting more inflows of gas from its European partners.
Today we could say that already something around 600 million of gas stored in Ukraine, which is gas of European companies. And that is also important for the security of supply in Europe due to the level of storages in Europe now, because it's very high. So I think that is a good solution for the business, and that is a good solution for European security.
Do you expect more coming, Minister, from Europe?
Yeah, we expect more coming. So I can tell you that we expect average something around from 500 to 600 per month. So, and we could offer. So our storages. We need 15 BCM for Ukraine for the next season, and so 15 BCM is open for storing in Ukraine.
Can we talk about what you expect to happen this winter, Minister, both in terms of the situation in Ukraine and what you think the energy situation is likely to look like in Europe?
I think that's very important. I mean, when we are talking about the gas, there's very important instruments which already started in the European Union. That is the joint purchasing platform, which would allow not to speculate the prices and manipulate the prices. And I think that is a very important decision. Concerning the Ukrainian energy system, of course, we are preparing for another hot winter. So, and I just recall you that the previous winter, we were living under everyday massive attacks on the energy infrastructure from Russia. So it started from the 10th of October, and the last massive attacks one was on the 9th of March. So, and it was every day by all kinds of weapons. So now we are preparing for the next winter, and we are not expecting that they wouldn't shell our energy system.
The Ukrainian energy minister speaking to Alex Steele and Guy Johnson on the gas flows. Coming up on the show, some British Muslims have told Bloomberg that their bank accounts have been unexpectedly closed. We bring you more on the debanking controversy right here on Bloomberg.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Ralph Lauren CEO Patrice Louvet there speaking to Bloomberg's Francine Lacroix. And you can watch the full interview with Ralph Lauren CEO tonight, 9:30 p.m. New York time. That is on Thursday at 6:30 p.m. London time. Well, ever since British politician turned pundit Nigel Farage said that the bank account of his was shut down because of his political beliefs, the issue of debanking has been thrust into the public spotlight. However, it's an issue that British Muslims have to contend with for a while. Joining me now is our fintech reporter, Aisha Ghani, who has been researching the story. Aisha, what actually happens and when do you get debanked and just how widespread is it?
Morning. So when I've spoken to people who have been impacted by having their bank accounts shut, what has typically happened is that their account will be frozen for a few days or for a few weeks. And in that time, they have been unable to access their money in their accounts. It means that their direct debits have bounced. They are unable to pay their bills. I spoke to one man, Akil Ahmed, who was a former postman in Luton, and he was frozen out of his account for 6 weeks. And in that time, he wasn't able to pay for his groceries, and then eventually the bank did shut his account down, as well as his wife's joint account and the savers accounts of his children. Now, it's pretty widespread. We know 1,000 bank accounts are shut down each day, and it has been going up and up in the last few years.
Well, I mean, obviously the Muslim community has been hit particularly hard by this debanking. Is that fact? Where are we with the data on that?
Yes, so we know that Muslims have had less of access to financial services. We also know that most Muslims, so in terms of the people who are unbanked or don't have bank accounts, 1 in 10 Muslims don't have bank accounts, so they are particularly impacted by the lack of access to financial services. Now, over the last 2 decades, when it's also compounded by post 9/11 and 7/7, as well as hostile environment policies of the UK government, it has meant that people have been impacted by many more ways, and then having a lack of financial services also compounds this.
Okay, Aisha, thank you very much. That is Aisha Ghani on the debanking in the United Kingdom. Quick snapshot of Tencent. This is the top line for you. The revenue missed 149.2 billion. So that's sub what the estimates out there was. But there's a couple of other lines in there which, reasons to be cheerful. I'll leave you with a cheerful note, which is, of course, the net interest income is on the up on the social network. So I'll leave you with one uplifting thought.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Inflation very much in focus. The Fed's Neil Kashkari warning that he's not ready to call an end to rate hikes. Fed minutes from the last meeting drop at 2 p.m. Eastern. How many will be in Kashkari's camp? UK inflation comes in hot again. The pound jumps as holiday prices keep rising. Service sector inflation remains sticky. The news, of course, piling pressure on the Bank of England to keep raising rates. And financial giants face fresh China scrutiny. BlackRock, Allianz, Fidelity, maybe amongst key stakeholders to watch in the Country Garden debt crisis. This as more local wealth managers miss payments to investors. Keep an eye on that story. Welcome to Bloomberg Surveillance. This is the early edition. I'm Guy Johnson. I'm, of course, in for Danny Berger in London. Kriti Gupta very much in New York. Kriti, there's a lot to think about. This inflation narrative front and center. China not far behind.
Not far behind. I would argue interesting kind of read through into the market stateside, Guy, because you would think that if those Chinese concerns really did have a read through, you would see more of a sell-off. And we're seeing the exact opposite this morning. Green on the screen when it comes to the equity market. Futures higher by about 0.2%, 44.63 for our radio audience on those contracts. But Guy, the market really gets interesting when you look at the bond story simply because of those contradicting inflation metrics. Remember, we had Neil Kashkari, as you just pointed out, saying, well, we might not be done, while all the data kind of points at, well, maybe we might be. So, of course, we're going to kind of, everyone's going to play economist for a day, if you will. And I think the bond market is already doing that. The 2-year yield coming back down to tune about 5 basis points, 4.89 on that note. What's interesting is that it is also dragging down the dollar. Now, some of this is coming from the UK, so we're going to talk about the counterweights in just a moment. But take a look at the Bloomberg Dollar Index, weaker at the moment by 0.2%. Again, the China read-through, not really there, even though, Guy, I should mention, we did just get Tencent earnings just a few minutes ago. They came in weak, so perhaps yet another warning about the strength of the corporate sector in China as well. And, of course, NYMEX crude trading with an 80 handle, about flat at the moment, but you can definitely see the direction of travel is down.
Bit of data out of the Eurozone, Euro area, Q2 GDP 0.3, estimates 0.3. That's pretty much in line with estimates, as I say. What I think is interesting is take a look at the screen right now. Take a look at your Bloomberg. Look at the industrial production number. Comes in way better than anticipated. This is a theme that is developing. The industrial side of the economy seems to be gaining a little bit of traction at the moment. Keep an eye on that. Let's talk about where we are with European stocks. 456. We're basically not too far away. We continue to be not too far away from the 460 level. The markets are getting more exciting as the week progresses, definitely. They started off definitely on holiday, seem to be coming back a little bit in drips and drabs, but we are still in a very tight range. I think I would argue yesterday, negative session. We're a little bit positive this morning. The pound up, unsurprisingly, given that inflation print that we've just had out of the UK. It is coming down slowly. The problem is, though, that core is sticky, services are sticky, holidays are sticky. All of that putting pressure on the Bank of England, plus the wage number yesterday. So the pound is rising on the back of that, 127.59. Kriti was mentioning Tencent. NASPA's the proxy. This is what we've got in terms of the reaction to the numbers. NASPA's is down because Tencent has missed. So that stock down by, let's call it circa 3%, Kriti.
Yeah, a lot to digest in the corporate sector from China as well. But I think the UK perhaps driving the market more in the bond market and the currency market, I would argue this morning. Let's go there. The UK's annual inflation rate fell last month, but by less than expected. This comes as the cost of travel and holidays climbs. The latest figures adding to the case for the BOE to raise interest rates again. Joining us now, Bloomberg's Valerie Teitel. She is all over this data. Valerie, walk us through it.
A lot of the attention this morning was on the core number that came in a tenth stronger at 6.9%, matching the previous month estimate. And if you look at where the trajectory is for core inflation here in the UK, it really has not budged. In the last 3 months, it's only gone from 7.1% down to 6.9%. That is really not a lot to celebrate when it comes to the Bank of England. There was some good news for consumers in this print that headline CPI did fall, driven by a fall in food prices, a fall in consumer goods, which is good for the consumer. But for the Bank of England, it's bad news. We are seeing domestically generated inflation. That is the concerning bit. Very sticky. Services inflation remains sticky and is still on the rise despite the fall in headline. That is the one concerning thing. And Kriti, if you look on a large scale, the thing that tempted the Bank of England to hike 50 basis points last time was a hot wage number and a hot core core CPI print. We got those two today. The fact is, though, we have a long way to go until the Bank of England meets again. It's not until the 21st of September, and we do get another round of data.
The last time I listened to the governor, the last press conference, he was talking about the fact he was nearly done. We're getting ready to pause. That was the message that's been coming from a series of central banks, or at least was. The message seems to be hardening. Kashkari yesterday. It's going to be interesting to see what the minutes tell us today. I suspect the Bank of England's going to have a little bit of a rethink again. Do the markets need to have a little bit of a rethink? How much is being priced right now in terms of the idea that actually rates could be, as they've been telling us, maybe higher for longer?
Well, look, the one big, I guess, vulnerability for central banks that have gotten too dovish too early is just clearly in the bond market, with those real yields staying ever higher for longer. I think the U.S. is a different slight scenario, though, because if we look specifically at what's been supporting U.S. growth, it's been government spending. And what has that caused? A surge of Treasury supply. What has that caused? This surge that we've gotten recently in real yields. And the concerning thing is in the coming months, the trajectory for government spending, we're headed into election year. It's still going to be strong in the U.S. And then if we do get a downturn, we get all these automatic stabilizers of welfare payments. So the trajectory of real yields, to many in the market's minds, is ever higher from here. And that could cause a bit of headwind for equity markets going forward.
Certainly a lot to digest, and of course, we keep coming back to the same theme. Where is the kind of read-through coming from? Is it coming from Europe? Is it coming from China? Of course, something you're going to be monitoring very closely. Valerie Teitel, everyone, for Bloomberg News. We thank you as always. Let's go from Europe over to China. The fate of global investors is in focus as Country Garden sits on the brink of a maiden bond default, with major firms exposed to the property developers' dollar bonds. Joining us now, Bloomberg's Rebecca Chung-Wilkins. Rebecca, walk us through who might be on the hook. Who has the exposure here?
Well, some of the big names that we recognizable to a lot of folks here: BlackRock, Allianz, Fidelity, HSBC, among some of the largest firms with the biggest exposure, at least according to recent filings. Now, worth pulling out a couple of those names. BlackRock up there right at the top, about $350 million US dollars worth of outstanding notes. That filing is just as of a couple of days ago. So most likely seems they probably still have some decent amount of exposure, particularly given the lack of liquidity in this market. Now, just thinking about what that means and the levels of losses that some firms, not necessarily these, but some investors may be seeing on their books. Just a couple of months ago, Country Garden's bonds were trading well above 40 cents. We're now in the sort of 9 cents, 10 cents, 7 cents range. So a significant drop off there. And also worth pointing out at the levels at which these distressed bonds are being priced at. We're not just at a distress level. Investors are not just pricing for a haircut, but for a really steep haircut. They're not at 20 cents. They're not at 30 cents. This is a very, very low level here.
So what happens to local investors as well? I'm seeing more and more trust companies. There's news that they're not making payments. Can I connect the dots? Are these things related?
Yeah, that's a really interesting question, Guy. I mean, on the first point, the next big thing for Country Garden investors will be whether or not they make this coupon payment. So that's going to be about roughly 3 weeks. So look to the sort of first week of September to see whether they make that payment. Onshore, it's been a slightly different situation. Developers have tried to avoid defaulting on onshore, where, of course, the bulk of their business is, instead sort of extending due payments. But as you say, this sign of distress in the shadow banking market is very much connected to the property stress. So trust companies, which have been another form of sort of extending credit to property developers, are now also feeling the pain as more property firms struggle to repay that kind of debt too. Now, shadow banking has been sort of heavily clamped down on by Beijing over the years, but precisely because of these hidden risks. And there are a lot of concerns over sort of transparency once again here. Now, we've seen a giant of China's private wealth management industry, firms affiliated with that, missing payments on trust payments. We had more news of more missed payments as well. We know that regulators have launched a probe looking into the risk of contagion here. But any kinds of stress that spread beyond just this one big giant, and even just seeing it happen at this conglomerate, does suggest we are moving into a different and new, potentially more worrying phase of the distress cycle when it comes to looking at the fallout of this property debt crisis.
the fallout indeed that we're going to be monitoring very closely. Rebecca Chung-Wilkins, all over that story. We thank you as always. And of course, we go from China back to Europe. The world's biggest owner of publicly traded stocks, the Norway Sovereign Wealth Fund, returning 10%, so about $143 billion in the first half of the year. The gains indicate the fund is back on track after one of its worst years. Joining us now to break it all down, Bloomberg's Jan Patrick Barnard. Jan, one of my favorite kind of fun facts about the Norwegian Sovereign Wealth Fund is that back in 2008, when you had that massive tech sell-off, everyone was kind of in the doldrums. This is a fund that really scooped up a lot of tech, a trade that would really prove quite wealthy ultimately for the next 10 years or so. What drove the returns this time around?
Well, it was no surprise here. Tech again, as the fund, of course, it's so large. So there are two things that they need to do. First of all, I mean, they want to be in the part of the equity market where there's the most juice, and that is still undoubtedly U.S. tech, even with the wobbles that we saw last year. So that is still a big weight for the fund. And on the other hand, given it's so big, it also needs to pick those stocks that are big in market cap, because it makes it easier for the fund to handle it going in and out in those stocks, because they just simply provide more liquidity. So no surprise here that the fund is like big in US tech, and that drove a major part of the performance, as we saw like the Nasdaq being up almost like 40% this year.
JP, that worked. What didn't?
Well, there are a few other things. Again, the fund is so large that you have to spread your assets all over the place to make sure you're well diversified. But that also means like it has a lot of benefits, but it also means like that the chances are high that you are almost always part of something that doesn't work. And that in this case was some losses here from Silicon Valley Bank. So the fund was also involved in that one. We also saw that commercial real estate, non-listed commercial real estate is an issue for the fund. I mean, we just heard from what's going on in China. So that's probably an issue to stay. And then renewables is also something that didn't work very, very well for the performance. Again, something that we have seen in Europe as well. If you look at the results of Siemens Energy or of Vestas, then you know what's going on there. And that's not an asset that is performing particularly well in these last couple of months.
JP, thanks very much indeed. JP Barnett joining us on what is happening with the Norwegian Wealth Fund. We're going to hear from Nikolai Tangen, the CEO of that fund. That interview is going to be on Bloomberg Surveillance. It's going to take place at 8:15 a.m. Eastern Time. Looking forward to what he has to say. A little bit more detail coming, I suspect. Coming up in this hour, though, today's UK CPI definitely fueling BOE rates hike bets. What happens next? We're going to find out. We're going to get a guide to what could be coming from the bank. Senior economist Callum Pickering joining us from Berenberg. Plus, US retail earnings in full swing. Target reporting its results in just over an hour. More ahead of that. This is Bloomberg.
Well, the story is all about the bond market. Even though we are smack in the middle of the summer, you are seeing some sleepy trading, yet plenty of action. I think Guy Johnson will agree with me on this, which brings me to a chart I want to show you. For our radio audience, stick with me. It's a pretty simple one. We're looking at the 2-year yield, nothing too fancy, but it's a chart that goes all the way back to, let's call it the spring of 2022. And basically what you see is this acceleration in the yield story. We knew that, inflation ramping up. And then it kind of stayed a little bit range bound for, I want to say, the next, 18 months or so. But it is continually testing that 5% level. I think this is interesting as we talk about what the terminal rate might be, guys. Simply this idea that you continue to see this yield story moving higher and lower, not necessarily on a change from Federal Reserve policy, but I think more from the cut story that's priced into the market. And yet here we are again this morning retreating from the 5% level.
Yeah, it's a key line in the sand, isn't it? And it's a massive moment for the market once again. The narrative seems to be quite clearly, though, that the Fed is going to push back on the idea that we're going to see cuts. The market up until now has not believed the Fed when it says it's not going to deliver cuts. But the market keeps being confounded by the Fed. It actually continues to be confounded by the data as well, which keeps coming through stronger. You look at the nowcast data at the moment, it is pointing to a US economy that is miles away from a recession. Why would the Fed be cutting if we are miles away from recession? Why would the Fed be cutting if we're still in an environment where it doesn't know whether it's beaten inflation? So the market keeps projecting and thinking, yeah, you know what, normal cycle, we're going to be seeing the Fed cutting.
Yeah, and I think
the Fed just keeps pushing it back.
I think to your point, it comes back to the same question that we've been asking our guests all week. Resiliency or recovery? What does this actually look like? Because if you are looking at resiliency, if you are looking at that confidence in the market, does that just mean yields go higher and higher? And at the end of the day, when does market plumbing and the bond market specifically become an issue for the Federal Reserve? Essentially, at the 2-year yield, it is at the tied to that Fed policy. So if the Fed is saying, look, we're not going to cut, but the economy is doing fairly well, that's not great for people who are betting on or who are bullish on bonds moving lower.
Absolutely not. And you've got two different arguments as well. You've got the front end story about Fed cuts, plus you've got the long end kind of deficit story, this bear steepening that we've seen, which could keep rates over the longer term higher, which is something else that the market's had to deal with. So that kind of move up in the middle, in the belly, has been really significant as well. That's been certainly something to watch out for. The idea of cuts just continues to really. The market's really struggling with figuring out what it's going to look like. What kind of a curve are we going to be getting? And there's all kinds of things at the moment pointing to higher rates. And then you extrapolate that and you take that into the equity market. The equity market is not positioned for these kind of high real rates as well. That is another factor that we've got to bear in mind here. You then fold in liquidity. As that starts to ebb away, is that going to be another problem, another headwind for the equity market?
Yeah, and a lot of that has to do with simply those longer term kind of stories when you talk about those inflation expectations that you just brought up. But then you have to talk about the consumer inflation expectations as well. Ask your man on the street. They'll say, well, actually, I think inflation is going to be there for longer. Guy, we're going to digest all of this coming up shortly. We've got Callum Pickering from Berenberg Economics. We also have FOMC minutes coming up later. We're going to digest all of it. But for now, stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. Let's get some key news developments we're following this hour. President Biden says he plans to travel to Hawaii to see firsthand the devastation from the Maui wildfires. Biden says he's spoken to Governor Josh Green, so the trip does not interfere with the rescue work. The wildfires have killed almost 100 people, making them the deadliest in the United States in over a century. One risk modeling firm says the disaster will cost insurers more than $3 billion. Guy, this is an evolving situation. We know the death toll keeps climbing. Yep. All eyes on Washington about how they're going to handle it.
Yeah, there's been a lot of criticism as to why the president hasn't engaged with this story a little bit earlier, why he hasn't gone. You've seen this time and time again during this administration, that maybe the administration has been slow to respond to crises. You saw that with the derailment. Maybe we're now seeing that with Hawaii. I want to talk about what's happening with the union story, because this labour market narrative, I think, is so fascinating at the moment, Kriti. The leader of the United Auto Workers Union is asking members to grant him the ability to call a strike. Now, this is interesting because he's arguing that the contract talks with the big three in Detroit, so the big three car makers, basically are moving too slowly. The group has been negotiating with GM, it's been negotiating with Ford and Stellantis for 30 days. The parties have yet to discuss economic terms. He wants to get on with it. He wants to accelerate the process. Now, obviously, there's a kind of mechanical process that he normally has to go through. And he's saying, you know what, we need to speed it up. We need to basically get the rubber to meet the road, and we need to get on with this.
What's interesting is he's essentially taking a page out of the Teamsters Union playbook. This idea here that you should actually be have to be more aggressive towards these companies rather than kind of engaging in these diplomatic channels. It's something, by the way, that you're seeing even the Hollywood strikes kind of use as a way to deal with the studios as well in California and around the world. So certainly something you want to keep an eye on. We should mention, by the way, we have an open invitation to the United Auto Workers president in right now. So hopefully he will join the network soon. But Guy, in that same vein, let's talk about an industry that's actually been affected a lot by the unions. That, of course, is going to be the logistics story. An affiliate of Ken Griffin's Citadel is said to have acquired roughly $485 million in yellow debt, previously owned by Apollo and other senior lenders, to the bankrupt trucking firm. The deal comes as Yellow seeks to secure a bankruptcy loan to fund its liquidation. Now, of course, remember, for the folks who aren't actually following this, the Yellow Trucking Company goes back almost a century in terms of kind of really building, I think, the infrastructure of the United States. But in the last 10 years or so, it really hasn't been able to recover from the global financial crisis. And that is an important part of their bankruptcy story. Now, in recent weeks, they've actually come out and said, well, that Teamster union, which represents, I think, a good chunk of their workers, not the majority as it does with some of the other logistics firms, but a good chunk, they are actually saying, well, it's because of those union negotiations that we went bankrupt, even though we do know there is that a loan that they still have from Congress issued to them during the Trump administration. A lot of cross currents here, but Wall Street already acting on what they're seeing.
Absolutely. A lot of people I've been speaking to, this is not my opinion, this is the people I've been speaking to, believe that this company was already on the brink, that it's been teetering on the brink for a very, very long time. I think pointing fingers maybe is a little unfair at this point. But I think the bigger picture that you raised about what's happening with unions, I think, is really important. There is a clear demographic shift which we are beginning to enter. You've seen labour shortages from the pandemic. That story feels to be over. We're now entering a kind of new phase. And we were talking yesterday with Jean Boivin about this, a new phase in which the demographic story is going to mean that there isn't going to be this large labour force. And in that environment, you would have thought that labour, you would have thought the unions would have significantly more power. And that, in theory, could drive higher wages.
Well, it already kind of is, and you can see that in some of the bottom lines. I mean, UPS, for example, a couple weeks ago, their stock tanked simply because of the margin pressures coming from these wage negotiations. Disney, Netflix, they are dealing with the same issue, Guy. This is something we're definitely going to be talking to our next eco guest about, no doubt.
Absolutely. I do wonder whether what the kind of the cases you raise, whether that's related more to what is happening with the pandemic rather than the kind of the demographic shift. Anyway, as you say, we'll talk about it. Callum Pickering, senior economist at Berenberg, is going to join us next. UK CPI, hot. We'll talk about it next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Inflation in focus. The Fed's Neil Kashkari warning he's not ready to call an end to the rate hikes. Fed minutes from the last meeting drop at 2 p.m. Eastern today. How many will be in Kashkari's camp? And UK inflation comes in hot yet again. The pound jumping as holiday prices keep rising and service sector inflation remains fairly sticky. The news piling pressure on the Bank of England to keep raising rates. And financial giants face fresh China scrutiny. BlackRock, Allianz, and Fidelity may be among the key stakeholders to watch in Country Garden's debt crisis. This is more local wealth managers miss payments to investors. I'm Kriti Gupta in New York with Guy Johnson in London. Guy, we talk a lot about the China story, the inflationary story there, and whether or not they're actually exporting deflation. You're already seeing a pullback in their property sector, even their tech sector.
Yep.
I'm not sure that's having a read-through into the rest of the world, though.
It may not. This may be one of those stories that takes a while to come through. But in the past, for those of us that lived through and I know you read about it, those of us that lived through the devaluation, we have seen the impact that China can have on the economy. You came out of the last crisis, 2008, 2009, China powered the global recovery. It's not going to be there this time, potentially. Stock 600. I'm being told watch 453. There's a key line in the sand there on the moving averages. We're basically flat. Again, quite range bound. Within there's some individual stock stories that are worth focusing on. Pound's up quite strongly, up by 0.4%. The market seems to believe that yesterday's data and today's data, the CPI number, will encourage the Bank of England to go further. The market is now pricing 6% as the terminal rate. Tencent has missed the proxy in Europe. Naspers, big stakeholder. That's stock Kriti, down by 2.88%.
Yeah, I mean, you bring up a good point about the devaluation. And Guy, I will say I'm both older and younger than I look. We'll leave it at that here. When we look at the futures trade, though, it gets really interesting. Green on the screen at the moment, but paring back a lot of the gains we saw just 30 minutes ago in New York. 44.59 on the S&P futures, higher by 0.1%. Again, not any major conviction in either direction, but enough to say, look, maybe there is a little bit of positivity. Remember, yesterday we sold off, though, so it might just be a simple reversal of that on this light summer day. The 2-year yield gets interesting as well because really it feels like the repricing is mostly coming from the bond market, not necessarily the equity market. Those real yields are going to be playing a role, especially as we talk about the read-through, not from China, but from perhaps the UK and Europe, where you are getting extremely hot inflation data. 2-year yield 4.90 is where we'll call it. The yield story bringing down the dollar as well. And again, that's also going to be a function of the UK story. So that's going to be something we want to watch as well. Bloomberg Dollar Index down about 0.2%. But Guy, if we're talking about a pullback at some point or even resilience in the economy, you would think there would be more volatility in the crude market, and we're not really seeing that. NYMEX crude really testing the 80 level here, now 81, really unchanged on the day, but perhaps that's where the volatility is due to pick up.
Crude came up pretty rapidly. It now seems to be consolidating a bit. But yeah, it's a good point, and it's well made. Let's talk more about that inflation story, Kriti, and how the Fed is reading the narrative that it sees in front of it. Investors are now waiting for the Fed's latest minutes. I think they drop at 2 p.m. Eastern. What we're going to get there is a glimpse of the official thoughts on the bank policy path from the last meeting. Neil Kashkari, though, has gone from being dove to being a firm hawk. And it was interesting listening to him yesterday, very much making the case that he feels that the Fed should not be done yet.
Are we done raising rates? I'm not ready to say that we're done. In terms of cutting rates, I think we're a long way away from cutting rates because core inflation is still around 4%. It's still around twice of what our target is.
So how many will be in Kashkari's camp? It's going to be interesting to see whether it's just a minority that believe that the Fed could hold at these current levels. And what is the read across into other central banks? You look at the wage data out of the UK yesterday. You look at the CPI number out of the UK today. Callum Pickering, senior economist at Berenberg, joins us now. Do you think Kashkari's right? Do you think the Fed might have more to do? The market's anticipating that we're going to be seeing cuts soon. He's pouring cold water on that.
I wouldn't eagerly anticipate cuts because all of the latest data from the US is consistently better than expected. There's a lot of resilience in the economy, but monetary policy is now tight in the US. By definition, that will disinflate prices over time. It's just a question of how long it takes. if you're willing to tolerate an 18-month horizon and just accept actually we'll benefit from this stronger than expected economic data, great. If you're desperate to get inflation down quickly, you run a recession risk. I think the Fed does not want to run a recession risk, and I don't think the administration wants a recession.
So it's done enough. It can sit tight. It can wait for the real rates to work their magic, and the economy will glide to a soft landing. Can you say the same thing about the UK?
The Bank of England is still on course for a soft landing. We didn't get the recession over winter that was widely anticipated. The outlook is for an improving economy over the next 2 years, but it won't happen immediately. The Bank of England should be thinking probably one more hike and then done. Slight risk.
Market's pricing 6% terminal.
Yeah, my view is that's too high. We need to just keep in mind central banks often make policy mistakes. They tighten too much and they ease too much. The reason why is because once the balance of evidence has shifted in favor of stopping or indeed hiking, depending on which way you want to go, they just go further. This is human nature. We have a bias problem. We know this. And so sensible policy accounts for this. It accounts for the fact that monetary policy works with a lag, which means you stop hiking well before inflation is back on target. If we hike until inflation is on target, you've gone too far by definition, you get your recession, which is the thing we need to avoid.
Callum, when we talk about the UK in international context, it feels like the narrative continues to be that inflation is stickier in the UK simply because of kind of the structural hindrances that the economy has there. Talk to us about how the wage picture plays a part.
So wages in the UK at the moment are much too high. Running at the 7 to 8% range year over year. However, the setup in which wages are being bargained up does not suggest that the UK is suffering from this so-called wage price spiral. Why do I say that? Inflation expectations on consumer surveys and the Bank of England's own survey are coming down fast and are now actually slightly below the Bank of England's target on a 2 to 5 year view. If wages are high in that context, we can't conclude that wages are being bid up in anticipation of high prices in the future. That's the conditionality for a wage price spiral, because those prices then become self-fulfilling once you spend those wages. What we actually see is tight labour markets providing workers with the ability to actually fight back against these cost pressures and defend their real incomes against the losses of last year. My bet would be, with a dramatic easing of labour market tightness, and there really is a dramatic easing now in the UK. You look at the single month estimates, employment is plunging, the unemployment rate is rising fast, vacancies are coming down. I don't think there's any basis to think that these wage growth numbers will remain elevated into the next few months. And in fact, actually, I think we're going to be surprised to the downside that wages lag inflation.
If wages do actually lag inflation, though, and you are still seeing this upward trend in even just nominal inflation in the UK, is that divergence concerning to you? And to me, that feels like there's going to be a massive dislocation then in the economy.
Yeah, I mean, we have to think about base effects, actually, when it comes to inflation. So headline inflation on the month of June declined by about 0.5 percentage point. That was due to the fall in energy prices, the prices that consumers pay due to a policy effect. The market has focused a lot on the core rate, which moved sideways at 6.9%. But if you abstract from the base effects, if you look at the last two monthly numbers for core, and you think about those in annual terms, actually core inflation is running at 2% for the last 2 months in the UK. That's down from north of 15% in spring. So there's been a huge drop-off in core inflation. The only thing that remains a bit of an inflationary echo is services, but that should turn down in line with wages because services have a huge wage component.
Governments are driving spending, deficits are going to be big, rates are going to stay high. We're shifting into a demographic deficit where we're going to be seeing fewer workers come in. That's going to give workers more power. All of that sounds inflationary to me. All of that sounds like we are going into a period where rates are going to stay significantly higher than they were pre-pandemic. What's wrong with that argument?
There's nothing wrong with that argument. The point that rates will stay higher is sufficient as a base case, but then the question is, what does the volatility around that look like? So I wouldn't say that inflation will be structurally higher. It just will be more prone to bouts of inflation because of this tighter balance between demand and supply. The other thing to say is that if monetary policy is set appropriately, there's no reason to have structurally high inflation. And central banks can pick their inflation rate. The big question here, the big uncertainty
Do you think that
is...
should change?
Say that again.
You think that sorry, just to be clear, you're saying that we shouldn't have the 2% target, we should have a different target?
No, we can get to the 2% target. Central banks can set that. It's just, it might need a 4% base rate into the future instead of a 0% base rate. Once you set monetary policy right, you can keep inflation where you like it. But in response to these price signals, do we get more investment? And that's where I think there's a potential upside risk here, because we can see the potential technologies that can be integrated into supply chains and into businesses that help reduce unit labor costs, they help displace labor, and yet we haven't seen that dispersion over the last 10 or 15 years. The price signal now is telling us to invest. If we tighten too much and cause recessions, you don't get the investment. And so this is a finely balanced policy dilemma.
Callum, a final question to you on the U.S. here stateside. We get FOMC minutes this afternoon, 2 p.m. New York time. What are you watching for?
Neutral from the Fed. They'll stay data dependent. I'm almost desperate now for all central banks just to stop hiking rates as soon as possible and just let the past hikes over the next 12 months work their magic. And if we avoid recession but land at 3% on core inflation, that's absolutely fine. It's much better than a recession that puts the economy back to sleep, and then 3 years from now we're stuck where we were in 2013 to 15 with no inflation, low interest rates, and this incredibly sluggish economy. The great thing at the moment is economies are awake. They're moving. We have price signals. Employment is strong. It's very, very risky to end this process.
A believer in the monetary policy lag. Berenberg's Callum Pickering, we thank you as always for joining the program. Coming up, we go from the macro to the micro. Intel terminating its agreement to acquire Tower Semiconductor. More on that next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. Intel walking away from its $5.4 billion deal to acquire Tower Semiconductor for no other reason than regulatory issues. Surprise, surprise. We're joined now by Bloomberg's April Roach, joining us all over this deal. April, this was a pretty heavily kind of marketed deal, it felt like. Why is Intel terminating it now?
Yes, so Intel announced this morning that it is terminating its plans to buy Tower Semiconductor due to difficulties with getting regulatory approval on time. And Bloomberg had already reported that Intel was expected to have to call off this acquisition. The deadline for the deal was midnight, California time, on August 15th. And by that time, both companies still hadn't received regulatory approval from China. So under the terms of the agreement, Intel said it would pay a termination fee of $353 million to Tower Semiconductor for this.
Just talk me through why they wanted this in the first place. What was the industrial logic to do this deal?
Yeah, so the deal was part of Intel's plans to get into a faster growing part of the semiconductor industry. And that specifically is the foundry market, where companies make chips for companies on a contract basis. And while Tower Semiconductor had a relatively small presence in that area, it did have the expertise and customer list that Intel was lacking. So Intel was hoping to combine its plants with Tower Semiconductor and really tap in to that client list. But what we've been seeing is that due to growing tension between the US and China, it's becoming increasingly difficult for companies to secure deals that require sign-offs from regulators in Washington and Beijing, particularly when those deals involve semiconductors.
Bloomberg's April Roach all over that story. And we should very quickly point out that the regulatory approvals really did come from all around the world, China as well as the EU, of course. April Roach, again, all over that story. We continue with the corporate story and a look at retail earnings, continuing with Target on deck today. We're going to discuss what to expect from their results. Already seeing a pop in the stock. That coming up next. This is Bloomberg.
This is Bloomberg Surveillance. This is the early edition. I'm Guy Johnson. I'm in London. Kriti Gupta's over in New York. Kriti, it is 5:49 a.m. in New York City. Let's talk about the day ahead if you're just waking up. U.S. housing starts, the data there drops at 8:30 a.m. Eastern. You get the Fed minutes. They come out at 2 p.m. We're going to get remarks a little later from Chicago Fed President Austin Goolsbee. That happens at 2:30 p.m. Finally, of course, we get Target. We get TGX reporting earnings before the U.S. market opens.
Well, let's dive into that story a little bit. Target expecting to report its first sales decline in 4 years. Joining us now, Simone Foxman, all over that story. Simone, when I think Target, now I'm kind of traumatized a little bit by that one sell-off that we had that one quarter from Target where it was really all about inventory. And then it kind of took the entire market with it. This time around, are we going to see that same kind of pullback, perhaps, in the retail sector?
Well, on the inventory side, I mean, most analysts are pretty optimistic that the biggest issues are behind us. We did see the company pull down its inventory dramatically in the last 2 quarters, first slowly and then by a bit more last quarter, and we expect to see that continue. This is just moving past those pandemic-era supply chain issues where all of a sudden these retailers had all this stuff. They've been able to use discounts, sell it off, and that will hopefully improve margins. The concern on Target's side is, however, that we could see sales that are even worse than anticipated. What analysts are looking for is negative 3.75% comp sales estimate for 2Q over a year-on-year basis. But some of the alternative data sets, like Bloomberg Second Measure, have come in a bit worse. And I think if we were to see something like that, we could see a real negative move on the shares and maybe some impact on other retailers as well.
Okay, so we're going to look at Target. We're going to see what happens there. And then the next thing we're going to do is try and figure out what that means for the rest of the retail sector. Specifically, what does it mean for Walmart et al.? What kind of a read across am I going to get here?
I mean, Target lives in this world, sort of consumer discretionary, but sort of consumer staples, right? And it's really been pushing into the consumer staples side of its business. Food accounts for about a fifth of its overall revenue, and it's been trying to make that even more so. That's an important one for Walmart. That's somewhere that Walmart's really seen some strength over the last couple of quarters. Similar, you can draw this through to Costco, draw this through to some of the other retailers we'll see over the next 10 days plus. And if it can make money on that side, that's a good thing because that shows some resilience, even if the consumer's pocketbook is a little bit stretched. But, I mean, think about what we heard from Home Depot yesterday, which was they saw a pullback in some of those higher-end $1,000 plus purchases, things like patio furniture and appliances. That's something that could also hit Target as well in its sales of electronics. And, of course, that feeds through into Walmart, into Lowe's, other retailers. And so that's something that we're really going to be paying attention to. Exactly what are people spending their money on, and have we seen that weakness on the top end?
Guy, I've got to ask you, have you ever shopped at a Walmart? Just out of curiosity.
I've been to a Target. I've been past a Walmart. I've never actually been into one. But after getting so much grief from Alex Steele a while ago, when I was in Seattle last, I made it a mission to go to a Target.
The Target
my
dollar
producer
section.
at the time forced me to do so as well.
Well,
I spent a good half hour in there. It was very exciting. Slightly confusing, but very exciting.
Well, I think what's interesting for Target is that they do a little bit of everything. And that's really, Simone, the business model I think Walmart has tried to adopt as well. Because Target has groceries, they have furniture, as you just pointed out. They have that dollar section that everyone loves to go to. But then Walmart is really just kind of thought of as where you get your really cheap groceries and then your fuel, and that's it. Right?
I mean, Walmart does more than that. And I think that they've especially tried to invest in their food business. They've done a big push in that. They've tried to invest in some of their online businesses, bringing third-party retailers in to try and compete with the likes of Amazon.